on that next big print, like that's where I think we're going to be stunned at where these prices go to, where you're like, oh my God, I never thought I'd see $1 million Bitcoin this soon. $30 trillion will come chasing this $1.8 trillion asset class of Bitcoin. You're going to move into an era, I predict, about 10 years from now, where that's where the world we will be in, where MicroStrategy is the JP Morgan of the world as the leading financial service business. And well, there's a 10x move coming to gold and Bitcoin, and I think Bitcoin will be the fastest horse in the race because of.
Does the Omega candle, $100,000 move in a day up, does that happen before we get to $1 million, or is that something we'll see after $1 million?
This thing will go to a 7 standard deviation move, which will put it into some Omega candle like you're talking about. When that happens, and that's why Stan Druckenmiller thinks in the next 5 years we hit the wall, because I actually like Bitcoin better than real estate right now, for sure, because that's why I believe Van Eck and them are right. The stablecoin market's going to grow massively. What I wonder about, though, is think about it.
Mr. David Foley, thank you so much for joining me here today and being a playable character once again here on the show. I thank you so much for joining us today, sir.
Thanks, Brandon. Great to be with you again. And as I said in the beginning, I'm glad to see you wearing those Michigan State colors with pride. You're a true fan and former alum and hockey alum there, despite the tough loss. Impressive. I like that. I like loyalty.
I had to wear it on the next day just to show the pride and still fighting for the Alden colors, green and white. So awesome. No, we had a good talk about that offline, and you and the Providence, who's been very good the last 15 years, 20 years as well. So anyway, that's we were just talking offline about your history, and I think that's a great place. People talk about their story a lot of times, and I want a little twist here for the viewer. Your history and your knowledge in studying money, studying gold, studying monetary history, finance, all of that, and leading up to Bitcoin, how long you've studied Bitcoin. I think this is very important to quantify for people, not telling your story, but hey, how long have I been doing this in my history and managing hedge funds, et cetera, et cetera. So I'd love for you to kind of touch on that. And that's going to lead us into the rest of this conversation. Some interesting things we were just talking about before we went live.
Yeah. So just, really very quickly, I'll be in back. I grew up outside of Boston and, was always a curious kid. I was the youngest of four and always learning and wanting to learn, asking tons of questions. My grandfather in his retirement would sit there. I was being the youngest. They'd babysit me if my mom was at work, and my grandfather would listen to the radio, getting stock market updates. So I remember 5 or 6 years old asking him questions as he read the Wall Street Journal, and so that, I just loved business, to be honest, more than anything. Didn't buy my first stock until I was after college, but didn't have any money to do that. But I think that, was always curious about business. And then, I got involved as an investment banker out of college down in New York in the mid to late 90s. And kind of, again, I thought, to me, that was fascinating, is kind of working with businesses to do mergers and acquisition or IPO or restructurings. And that was always fun. And then debt financings. And then about 21 years ago or so, I moved back to Boston because I met a girl who is now my wife. And so it was time to come home from New York and join the hedge fund industry up here. And have been in the hedge fund space with growth equities to value investing, equities to debt and distressed debt investing for most of that time. So kind of a whole broad cap structure experience and the whole growth and background and value background. Did some private equity and venture deals as well as kind of debt and derivative type trades. So kind of seen a lot over the years. Bitcoin I came across through Larry Lepard, who had taught me about gold, a long time ago. It was before I was working with Larry and I understood gold right away. But Bitcoin, I challenged him. I remember back in 2015, he and I would have debates. I'd say, I don't get Bitcoin. I mean, look at Satoshi Nakamoto had a 10-minute blip where he had to patch it because the money supply of Bitcoin gyrated in 2010. And I think, to be fair to me, there probably was more risk in the Bitcoin ecosystem in 2014, 15 than there was by 17 through 20. And then, so I was at my hedge fund. Larry would host like lunches up here in Boston with Bitcoin experts around 2018 or so, 17, 18, that time frame. And unfortunately, I would send the founder of my hedge fund that I was at the time. And I regret that, because I think if I had gone, I would have probably gotten up the curve sooner, seen through some of the risks of Bitcoin, and been more of an earlier adopter than I was. I was kind of class of 19 is how I think about it. I mean, I had some exposure to that before, but really kind of went down the rabbit hole in 19 and saw it, doing the, hundreds of hours of diving deep and watching videos, and Andreas Antonopoulos, all that stuff, and Saifedean's book. But yeah, I understood gold. I understood the fact that gold is scarce. It's been sound money for 5,000 years because it's durable, and its scarcity, among other things. And then ultimately understanding digital scarcity of Bitcoin took me a while to see that. But around 2019 and 20 kind of saw that. And, been working with Larry at EMA since to that time. And then James Lavish and I started the Bitcoin Opportunity Fund about 3 years ago. And we've been investing in the Bitcoin ecosystem in public and private businesses and Bitcoin itself since that time.
How many hours, when you look back at your career, how many hours, how many years has it been? I mean, how many hours do you think you put in studying, just monetary history, studying gold, studying sound money, and then studying Bitcoin subsequently?
So, yeah, I mean, I was kind of the youngest of four, and, Larry Lepard's married to my oldest sibling, my sister, Susan. And so they got married in 1991, right when I was graduating high school. So I was an econ major in college at Providence. And, I would sit around with Larry all the time at various like family functions or summertime or what have you. We'd talk like economics and politics and world economies and sound money and Austrian economics. And so, I loved econ as a major, and kind of then Larry, and with his book, The Big Print, you can kind of see that data dump of Larry taking his years of knowledge. So I've been lucky to really have him as a guy. Like, I'll give, for instance, I remember 15 years ago, 2010 or even 9, Larry and I lived near each other, and our wives, my sister and my wife, would be kind of away on the summer vacation. Larry and I would be up here in Boston working. So we'd get together and grill burgers and sit around watching the Red Sox on mute, but we'd talk about the history of the Federal Reserve from 1913 on. And it's because I'm a curious guy and I just wanted to pick Larry's brain. And what's great about Larry is, Larry sometimes can be quiet, but boy, if you ask him questions, he'll like data dump on you like it's an Encyclopedia Britannica. And so I loved it. And Larry doesn't mind when I ask questions, and he'll go on and on. So I learned about the history of the Fed through Larry. I learned about Austrian economics a lot through Larry. And so, I've been blessed and fortunate to have not only great parents, but siblings who married smart people and learn from them. And so I'd say that, since about 2010, I kind of understood the gold aspect of why it's of value, and how it has compounded almost in line with stocks. It's interesting. I just saw an interesting data point. If you look at global debt is up 10x in the last 25 years since 2000, 10x global debt. Gold is up in line with that. It's held its value. It truly is an inflation hedge against this monetary debasement. And again, I think Larry and I have taught us over time, I think I'd sit there in the late 90s as a young analyst on Wall Street, and you'd look at the internet bubble, and I'd look at great fortunes being made in 99 on paper, and friends of mine in New York banks that would say Friday night, drinks are on me, I'm paying, because the guy's paper portfolio went to $1 million. And then I went out to business school, and I'll never forget, it was March 13th of 2000. I'm in business school. The 8:30 class is wrapping up at 9:45. And I kid you not, 50% of the guys in my class were bolting to the door to get their cell phones to call their broker. They were getting margin called. And, and these were guys that were smart guys that worked at Blackstone before business school. And so they had a lot of money, and they were they were gamblers. And, but some of those guys were honest. They'd tell you a month later, man, I had $1.5 million in my portfolio, and it just went to $5,000. And you're like, oh my God. Wow. So the history of debt and bubbles, kind of seeing that and being a curious person and learning at young ages, always stuck with me. So I think when Michael Howell kind of published that this morning of global debt up 10x in 25 years and global gold prices up 10x, I think that's what we're living in right now. I think that's what everyone's misunderstanding. I don't think people really, I think we say it, but I don't think we fully understand it, that like this has just been a debt party that just compounds upon itself and feeds itself with more debt to pay off the old debt. And when you get in trouble and illiquid, then just more debt. And like Silicon Valley Bank's the most recent example of that, where boy, the Fed didn't let that last too long before they came with the swap lines and guarantees. And that's where we're at. And I think that we'll get into that, I'm sure. But to summarize, and in fact, Larry and I were just talking about this about 10 minutes ago. I was late for your call, and the thing that the markets in the long term, like all the positive things that might be happening in Washington with spending cuts and getting rid of fraud, which is all good and necessary, and it's we should all, and Democrat, Republicans, anyone should cheer that. The problem is it's a fragile system, and I think Scott Bessent kind of understands this better than anyone down there, that you got to be careful. Like, this is brain surgery. You cannot come in with a scalpel on the brain. You have to have an intuitive surgical robot that's doing carefully the brain surgery. Because if you go and cut $1 trillion, well, then that feeds into Lynn Alden's fiscal dominance. You're impacting that, which is really going to have an impact on the economy. And it's so fragile with a levered economy that if you have any signs of deflation, it can spiral quickly out of control, as we've learned in the 30s, as you learned in '08. And so I think that that's not appreciated by markets, or just starting to be appreciated as the market's selling off here in the last few weeks, because it's discounting in risk to the economy from tariffs and that. So to answer your question, summarize, I've seen kind of gold from that perspective, and learning about Austrian economics, and then understanding this global debt bubble that we've been in, really, as Larry has taught me, since 1913. In my simple mind, it's really since 71 when we went off the gold standard. Everything from credit card mailings in the 70s and 80s to Michael Milken creating the junk bond market in the 80s, to the securitization markets that really opened up in the 2000s that led to the housing bubble. We have just piled upon debt because we've been all given hall passes to lever up as much as we want. Thank you to the Federal Reserve, who took interest rates down to zero to allow this debt party to happen. Now, the question we all should be asking is, when does that end? Do they lose the bond market and rates jack out? How does it end? Does it start to fall apart in the next recession, and the Fed just comes with fire trucks and fire hoses, cuts rates, and more spending? And in my opinion, that's exactly what will happen. And that's why Bitcoin and gold, again, grow with that debt, right? And Bitcoin is going to be even faster because it's such a small asset class. We don't think it is at 84,000, but it is. It's a call it a $1.7 trillion, $1.8 trillion asset class in a world of 900 trillion. We're still so early. So, to be honest, I don't get unnerved by all this market volatility of Bitcoin price, where it's going. Like, highly, highly confident where Bitcoin prices will be over 5 to 10 years. Same with gold. But in the short run, you get these wobbles.
Hey, that's fascinating. What was that evolution that really you led to, like 2019, when you were like, hey, Bitcoin is that thing that Larry's been talking about, that, I've been seeing rumblings about? What was like the aha moment where it kind of just switched for you? I guess like the orange pill moment. Like, what were those like? And then once you started really going down that Bitcoin rabbit hole even more, because I have a similar background. I mean, it's not nearly the same as yours, obviously, and your experience level is off the charts, but I came from like the gold world, real estate, stuff like that, sound money from that perspective. Mike Maloney, Robert Kiyosaki from 15 years ago. I was leaving Michigan State and started picking up all their books, Creature from Jekyll Island, and realizing, whoa, what is going on here? Is a game being played as I'm leaving college, and the '08 crash is happening. And so that to me was a wake up call. Went to the sound money aspect from that. And it was, hey, gold is money. That was the money. And these are just claim checks, the paper dollars. And so all that I had to start unpacking and peeling back those layers. But when I started really discovering Bitcoin, it opened up my world 2 or 3 more times than I thought I knew a lot at the time, and kind of had the game figured out. But you don't figure it out, I don't think, until you get to Bitcoin at the really, it's the final stop. So what was that like for you? What were those aha moments? And then also, what has shifted for you in your understanding of just geopolitics, macro, finance, investing since discovering Bitcoin and going down the Bitcoin rabbit hole?
Yeah. So again, continuing on with that 2015 thing where I'm saying to Larry, nah, it still feels so fragile. And some MIT core dev guys that you talk to up here would say, I worry that I'm going to hit a button and I'll break the system. And you'd say, see, it's not sustainable. Well, then 2017, as you recall, Bitcoin took off. And I can remember actually sitting at Thanksgiving with Larry debating it, saying like, it's not going to last. It's a bubble. Like it's speculative.
Mm-hmm.
And then sure as hell, as you recall, Bitcoin came down from 17,000 to like 3,000 or lower during, 17 through 20. And somewhere around like 18 or so when it came down, I remember thinking in my head, see, told you so, like it was a bubble, right?
Mm-hmm.
And again, I regret not being the axe at our hedge fund at the time to really spend more time digging into it. I was so busy with the distressed debt trade at that time from 2016 through 19. I was tasked with the distressed debt cycle at our hedge fund, and it was a brutal ride. It was, vicious cycles up and down. And you get your sea legs. It certainly calloused me to kind of be ready to handle volatility like Bitcoin. It doesn't unnerve me. I'm used to it with oil markets and commodities, and yet seeing supply and demand of oil, where you knew that price matters, supply will get cut, demand is going to grow in this range. It got temporarily delayed because of COVID then, but like in our head, we were like, by 2020, these oil markets are going to be rebalanced, and actually you're going to be short the stuff. And so therefore prices will be at, we thought $80 a barrel, and it overshot that a bit, but in general, it stuck around there for a while. And therefore all these companies from Halliburton to Schlumberger to these distressed debt bonds are going to be worth more. So I bring all that up because it teaches you about supply and demand. And so to answer your question on Bitcoin, around 2018, 19, then when I finally started digging deeper, it was really 19, through various books and just, people on YouTube, and then just digging in, again, friends of Larry and Larry that could kind of teach you this stuff when you had more time to listen at that point as I came up for air. It was the immutability, the scarcity, the fact that it is the scarcest asset in the world. It was the fact that it's really hard for people to buy gold, right? Like very few people can do it easily. Like, yes, you can go on some websites and bullionvault.com and buy some, but if you simply have a phone and you simply can open a wallet at Coinbase or one of these other, Noon wallet, a Moon wallet rather, whatever, you could be in Africa and buy this. And so this is an asset that's capped at 21 million, with its supply gets halved every 4 years, with global demand that not just, 144A accredited investors can buy. Anyone can buy it. And that was an aha where you're like, oh my God, like the supply of money that could be chasing this small asset class is massive, that it's so asymmetric that just to even get to half of gold's value is so asymmetric of where Bitcoin would be, that was kind of your aha moment when you're like, geez, now I see it. And moreover, the network was growing, the nodes in the world were growing, the nature and strength of the network itself and security of it allowed you to say, okay, this is, I think Austin Goolsbee at the time had talked about it. He was Obama's chief. He's now the head of the Chicago Fed, but he was one of Obama's key economists. And he said, the time for the U.S. government to knock out and kill Bitcoin was 2011. It's too late now. And it's like, that kind of was an aha moment where you're like, yeah, he's right. Like the network's too big. You'd have a protest. You can't do a 6102 like they did with gold. And so, because I think the times have changed. So I'm being long-winded, but I think that's by 2019, seeing kind of all those benefits as we move into digital eras and how Bitcoin is just a digital version of gold and digital capital. That's when it really kind of resonated, and how it's open to the world and how asymmetric it is and how secure it was getting. That's kind of what I saw as like, geez, this is actually a better story than gold.
So the other part of that, I would love for you to unpack what shifted after that. Once you were opened up to Bitcoin, and what shifted after that? Were there things that you realized that you just you're like, wow, never thought of that before. Did it bring you closer to like, hey, I didn't think about the environment at all, and now I think about it a lot more? Were there things where like, whoa, those were really these big changes? And also, do you subscribe to Bitcoin fixes everything? Now, Bitcoin obviously doesn't fix every single thing in humans' lives. However, it's a euphemism. Obviously, it's a meme for getting people to understand and very quickly, hey, all of these things you're dealing with financially, or a lot of these things politically, sound money fixes a lot of those things. And Bitcoin's the best thing we've ever found that can potentially do that. Is there anything like that where I would love for you to unpack some of that, where you're just like, yeah, those are things I just weren't on my radar before, but because of Bitcoin, now this has changed. And also, do you subscribe to the, Bitcoin fixes these things? And that's why I'm here.
Yeah, and I always love that saying, Bitcoin fixes this. What jumped in my mind at the time and still kind of resonates today is Bitcoin equals fairness. Bitcoin equals truth, right? That it's a math-based protocol sitting on top of TCP/IP. I mean, you think about the founders of PayPal, what their goal ultimate was trying to get to was an internet-based currency that could be a collateral settlement for internet money, like digital money. And Satoshi Nakamoto, whoever he, she, or they are, finally put all together after all the work Hal Finney and others have done, and Adam Back and others, but Nick Szabo, I think that it kind of all came together. And to me, it's fairness. It's when you have that math protocol that anyone can trust, that there's no counterparty risk. I don't have to trust Lehman Brothers is not going to do something illicit with the cash that I just gave them, which they did, moving it to London and rehypothecating people's assets. You don't have that. Is Dalio talks about that a lot, Ray Dalio, right? That gold and Bitcoin are the only non-counterparty monies in the world, non-debt monies, as he calls it, meaning when stuff hits the fan, whenever that next crisis happens, Larry and I were just talking about this morning, Larry and I always talk about it. To me, it's like 7 to 12 years type thing before this gets a real, like, massive issue in terms of global debt issues. Whereas Larry will be much more in the 3 to 5 year camp, and who knows, right? But we're all guessing. But the point is there will be that time in this global debt bubble that people, just like in '08, will want non-counterparty money. You will not trust a bank with a $500 billion derivatives book on it. You'll suddenly not want to take counterparty risk. Everything seizes, all the liquidity dries up, and then it turns into a solvency crisis. In those solvency crises where you don't trust whether JP Morgan can pay you back, or if GE has the wherewithal to pay you back, and therefore you're not going to ship them the supply, people run to non-counterparty money. It used to be U.S. Treasury bonds. It may still. I have my doubts. I think more and more in this new era, Bitcoin and gold are going to be what people run to. And so I think that was kind of one of the ahas as well, where you were like, geez, okay, I understood that about gold, but I really see this in Bitcoin, where the whole world can buy it quickly and move fast into it. And so when you have this next crisis, which will be at the sovereign level by definition, not just at the Wall Street bank level like it was in '08, because now the Fed bailed that out, and we've gone on since that time to just deficit spend and build debt. It's going to be I don't want to park the safe. Again, flight to safety used to be the phrase for buying U.S. Treasuries. That will not be the flight to safety. It won't. It won't. It might be in the T-bills, but it won't be for large swaths of capital. Like, that will be at the margin, some T-bill buying, because there's not much duration risk. And if T-bills come screaming into 1% because the Fed takes Fed funds back to 25 basis points, they're not going to go there. People are going to safe harbor in gold and Bitcoin, but Bitcoin's going to be the biggest winner because it's the easiest one and it's the easiest on-ramp globally. So that was, I don't want to be long-winded, but I think that was kind of the biggest thing that I understood and saw then of, okay, this is not only asymmetric, not only now secure, not only the scarcest commodity in the world, but this will be that non-counterparty flight to safety that everyone's going to run to in whatever crisis, whether it's 3 to 5 years, as Larry says, or if it's me being more conservative, kind of 7 to 12 years. And hell, who knows? It could be 3 months right away before this happens, but none of us know. But like we're highly confident in where this is going over the next decade.
It makes me think of Weimar Republic, which, you know, again, that gets to be so overdone, especially in our world, the sound money world, the Bitcoin world. It comes up a lot. However, Mike Maloney had his video series from 10 years ago, The Hidden Secrets of Money, which is so good, and goes through that, what was happening in the Weimar Republic, actually, where people were, you know, they kind of got fooled once, and then they're like, okay, but then once it happened again, like these violent swings back and forth, like you just were saying, that they're not going to go for this treasury gimmick again. Like, people are at the sovereign level, like they're not going to come in and just keep buying and just like, hey, we're going to keep buying this lie, this Ponzi scheme over and over and over again. At some point, people just say enough's enough. Is that what kind of what you're alluding to, where like we're in this place where people are gonna, you know, they're putting their money under the mattress, so to speak? At the time, that's kind of what they're doing. They're trying to get in and out of gold. They're literally putting, you know, money under the mattress type of thing. But now it's, hey, we've got some easy flights to safety now. Bitcoin, I mean, gold, like you said, is harder because it's physical. But is that kind of what you're alluding to, like some similarities between now and 100 years ago?
Yeah, no, I think that let me try and walk it through in a hypothetical of what a potential next crisis could look like. And again, I want to be careful that I'm not a doomsdayer. I'm just a guy that I'm that same curious kid that I was asking my grandfather
learn
questions
from history,
on.
though, right? Yeah, learn from history.
Right. But that's just it. And I think that for me, probably being at a hedge fund in '08 and having our fund did really well during that period of '07 through '09, like we crushed it. We kind of were properly seeing, you know, the pitches and understanding how to hit curveballs moving 94 miles an hour type thing. And so you kind of, I learned a lot from the people around me. Again, I've been very lucky in my career to have a lot of smart people around me to learn from. And what I would argue the next crisis could look like, whereas '08, the problem was the securitization markets that allowed all sorts of just excess leverage to take over and allowed kind of, again, the old Big Short movie or book stories of, you know, the proverbial strippers in Vegas owning 7 homes type thing. Yeah. You know, kind of that nut period that happened because no one was really paying attention in the securitization market where everything just got thrown overboard. It ended up in a cul-de-sac at Wall Street banks being the epicenter of ground zero of that problem. I actually think the banks in general are probably much better shape than they were then, except for the fact that they have a lot of off-balance sheet derivative stuff. And in any crisis, it becomes a liquidity crisis first, where no one wants to take that counterparty at JP Morgan or with I don't want to ship these supplies to GE because I don't know if their balance sheet is going to be there to pay me if I send this box of widgets. And so things seize up. And then it turns into liquidity crisis becomes solvency crisis always, where it's like, let me study everyone's balance sheet. If I'm going to send GE my widgets, are they going to be able to pay me next week? What type of, you know, guarantees can we get? And for a few months, like that can seize up where no one trusts that. And that's why the Fed always comes in with liquidities and swap lines to make sure that there's plenty of liquidity and lubricant in the system to keep things moving. And that's ultimately, I think, what will happen. So that's why, not to be a doomsdayer, because I think ultimately that will happen, but that's why gold and Bitcoin will do exactly what they always do. They will fly even faster. And on the next one, in the next big print, as Larry will say, it's going to be even bigger. It's going to move faster because the world's going to realize they are so trapped. They have no choice. They can never dial back what they've done at the Fed level. So to keep playing this out, I think the next crisis, though, will be, like, I'm just like, look at right now, the stock market's kind of bleeding here over the last month. What I'm watching is degrossing and deleveraging. I think the Millenniums and the Citadels, not to pick on them, and the Jane Streets, those type of big mega hedge funds, some of those guys are levering up 25 to 50 to 1 on various trades. And they'll say, oh, but I'm paired. I'm long this, I'm short that. And yeah, I levered both sides 50. And it's like, yeah, but that's like the same stuff that they said in '87 about portfolio insurance. That's the same stuff when I can remember being at Lehman Brothers' home building research team trying to tell me and about 12 others at a lunch in Boston in 2006 or 7 that there was no housing bubble, that not all housing prices go down at the same time in the United States. It's usually regional. California might go down, but East Coast stays fine. They forgot about the 1930s. Like, you know, and we were 70 years removed from that only. But like, I think we Americans are really guilty of that. We think like, come on, that'll never fall apart. That hasn't happened. And what do you mean? Millennium and Citadel will be fine, 50-1 leverage, but they're paired. And we fail to understand liquidity and how liquidity crunches and credit crunches can happen. And then solvency crises happen where no one trusts each other. And so to answer your question, land the plane, like,
if you're liking this interview, but you're just wondering, you know what, Brandon, this is amazing stuff. And I get you have these guests on and they're talking about how orange pilling the world is so great and how Bitcoin is going to take over the world. How in the world do I educate my family and friends? How do I get people to understand what most people just don't care about, quite honestly? Bitcoin trading cards is the way to do that. When you open up these cards, you see the foil cards, you see the chase, you see the glossy cards, young, old, boy, girl, man, woman, it doesn't matter. People love these cards. It's awesome because they're super valuable, by the way. Amazing little side note. However, it Trojan horses them into the most important thing of the day. It's not politics. It's not all the things that we fight about. It's changing the money, fix the world. Bitcoin trading cards is the best way that we have going in order to do that, no matter who you are. You're going to love them. Playable Characters 10 for 10% off at checkout. Playable Characters 10 off at checkout. btc-tc.com. You're going to absolutely love these things. Now back to the show.
Yeah, I think when that next one happens, and it will definitely happen, in my opinion, within the next 10 years, and it could be as soon as the next 3 to 10 months. I have no idea, but it will happen. It's going to be, that solvency crisis will be, well, I'm not going to go running to JP Morgan and I don't even want to buy a CDS contract because JP Morgan's on the other side of that, and I don't know if they'll be there in a week. I'll run to the non-counterparty, non-debt money of gold or Bitcoin because I own that. And I own it physically, and no one can take that. I don't have to rely on JP Morgan being there next week to pay me back. I'm good here. And so that's what I think kind of this next crisis is going to be, where if it's stagflationary and rates are jacking out to 10% and the quote unquote, they've lost the bond market, that's all the more where no one's going to fly into a treasury bond or bill when you know that rates are going from 7% to 10% over the last week. You're going to say there's so much risk in that because as rates go up, the bond price goes down. I'll store it in Bitcoin and gold, thank you very much, because those are capped supplies, or scarce supplies rather, and in Bitcoin's case, capped. That's what that will look like. And I think that, ultimately the Fed will have no choice but to come in and do yield curve control. They will come in just like they did after 1945 after World War II and say, rates are pegged at 2.5%. They cannot go out to 10, and we're just going to print money. We buy bonds. We buy bonds at the Fed to keep it at 2.5% pegged, to keep the lubricant system. But as Larry points out in the big print, in that next scenario, given that we've all been hyper-focused on this, as particularly for the last decade at least, of global debt and sound money has come back in vogue again, like massive amounts of capital are going to fly into gold and Bitcoin. And again, 300 trillion out of 900 trillion global assets, global financial assets, 300 of those are bonds. If they're doing yield curve control, like no one's going to want to buy bonds, like because of the money printing that's going on to do that. Now suddenly U.S. money supply won't be growing at 6.8% on average per year, right? Which, let's just pick on that for a second. The U.S. money supply has grown at 6.8% a year for the last 52 years, 54 years rather. And so that's true inflation. That's Austrian economics would say that's inflation, 6.8, not 3.1% CPI. And on that next crisis, you're going to start seeing probably average money supply growth of 10 to 15% a year. So you're going to need yields of like 18% to 17% just to run in place probably. Well, then think about what that's going to do to this global debt system that everyone from Millennium and Citadel to the U.S. government to people with 24% credit card debt paying 24% a year, the whole thing just comes flashing down, except you do yield curve control and they're going to have to print money. So on that next big print, that's where I think we're going to be stunned at where these prices go to. Power law theory, I think is really interesting. And I actually think it's worth paying attention to a lot. But like that, I could see us overshooting like 7 standard deviations above the norm for a temporary period in that, where you're like, oh my God, I never thought I'd see $1 million Bitcoin this soon. That's what I think the next crisis, on the other side of that crisis, if they're doing those things like I'm saying, how that will play out. So I think that's kind of, I think, what kind of could rhyme like, and where the epicenter of the crisis will be. And it'll be probably more like the levered hedge funds more than the banks, but the banks too will get dragged in because of their off balance sheet liability. And ultimately just the Fed will come back in and just have to do this. So I'll pause there. I hope that wasn't too long winded.
No, this is exactly why we have our block of time here, so we can go as long as we need and get deep into stuff. I mean, that's the beauty of this. Honestly, we can kind of sit down and not be, hey, we've got 20 minutes to, kind of like a news channel. Like, that's part of the news problem, right? Like, you can't get context. So I think that's why this is so important. Yeah, I couldn't agree more with all you say here. And like you said, it's not to be a doomsdayer. And in a few minutes, I want to talk about why the system is this way, because it's a lot of, flights to safety, talking about debt. Why are we in so much debt? So in a minute, I want to talk about that with you. But we offline, right before we got on, you were talking about the London LBMA, I think it was, in the 60s, and how you think we're kind of repeating. Because my Weimar question, you kind of just talked about that and beautifully wrapped that up, where people are kind of rushing in and out of things because they're scared. Now they're, this was blowing up, and now this thing, there's all these dislocations in the market, and that's what we're experiencing. So I would love for you to touch on, in the 60s, what was happening and how this reminds you and Larry of this time as well.
So yeah, and this is a good exercise for everyone, is when you get some quiet time, just go to Wikipedia and just type in London gold pool, and just take 10 minutes just to read that, like, kind of write up on it. And in particular, go to the crisis section of 1967. I mean, in essence, what it was, I'm going to oversimplify it, but it was like a classic regulatory, like, let's price control the gold market and let's all collude here as banks and keep it together. And like everything, kind of like we're talking about with Citadel Millennium, and like people like use leverage to kind of build up paper shorts on Bitcoin, meaning gold rather, at the time. Like the syndicate banks at the time would say, like, okay, I've got this amount of physical gold, but I'll just lend 3 times as much out, or now 7 times, because I got away with that. Hey, this revenue feels good as we're lending this out, and hopefully these people don't come calling for their gold, because if they do, I only got 3 bars and I lent 7 to 10. I'm short. I've got to go out and buy more bars to. It's, by the way, this is no different than what Madoff was doing on a Ponzi scheme down in Florida at country clubs. Like, he needed new investors to come in to pay off the investors looking for their money. And I think that's effectively what London Gold Pool was doing. They were trying to paper short, control the market. Well, in 67, it began to blow up. Why? Because inflation at that time was picking up. We had the Vietnam War going on. Then in the US, you had the Great Society with Johnson trying to create things like Social Security, Medicare. So people saw and in London, by the way, had massive inflation well before that, partly because of the post-World War II economy and some of the decimation that happened there. But they were seeing inflation, then the US was seeing it. There was a run toward gold, right, as an inflation hedge. The same reason why there'll be a run toward gold and Bitcoin now, and any future ones, of money printing or inflation, what have you. And I think that what you had then is, effectively in 67, people were calling for their physical, because they knew, like, this inflation's real. And the neighbors down the street have been talking about this thing called gold for a few years. We better buy some of that too. Well, okay, now suddenly demand was outstripping gold supply. If you're short like those banks were, you better cover those shorts, because you're about to get steamrolled. So they did. And so the London gold pool collapsed, you'll read about in 67. Well, I point that out because, does that sound familiar? It'll be that same thing in that next crisis, where all the people that all of us are orange pilling, that kind of laugh at us and are like, yeah, geez, it went from 110,000 to 84. How you feeling now? Like, you idiot, and you're like, you guys don't understand the long game that we're playing here, and what this is all about, and how the history of economics works. This is that same thing. Those people will come rushing into this non-counterparty money of Bitcoin and gold. Well, the same thing, to answer your question, is happening right now in the gold and silver markets. We think it's like London Gold Pool 2.0 playing out. If you look at what happened over the last 2.5 years in gold, first off, gold's had an 11 to 14 year bear market. It's had a couple good years here or there, but in general, the thing got oversupplied. Gold miners did through 2011. And then in that bear market after that, it got undersupplied. It's been capital starved. The whole industry has. There hasn't been much capital formation. Gold miners, just you can't find as much as before. Tavi Costa has a lot of good charts on this. There's a lot of guys that have a lot of Trey Rack has great stuff on this too, on the gold supply and silver supply, how it has been underinvested in. Well, what you have now, though, is that over the last 2, 3, 4 years, the central banks out of the Far East, like Asia, Turkey, they've been buying up gobs of gold and silver, and partly because they created the Shanghai Gold Exchange to really compete against London. And the Shanghai Gold Exchange was set up to service the BRICS, right? Because part of the BRICS deal is each BRICS country is going to need to have, some number, 5% of their reserves in gold. So that way, if Saudi Arabia, that doesn't really trust China, I'm willing to sell you oil for yuan. Saudi Arabia, will sell you China oil for yuan. I don't need to take US dollars back like I used to. But I want to turn around with your yuan on the Shanghai exchange immediately and just take gold off of that and get rid of my yuan because I don't want exposure to you guys. I don't trust you. That's me talking. Well, gold is a central part of the collateral package to have a seat at the poker table in the BRICS. So all that gold was being siphoned out of London the last few years. Well, guess what? JP Morgan just brought $4.8 billion worth of gold back to New York about a month and a half ago. Some would say, well, that's just because the tariffs are coming and they want to get ahead of that. I'd say, no, that's like the London gold pool. Everyone realizes that the world, there's not enough physical over there left. And in fact, if you go to the London banks, bullion banks right now and ask for physical gold, it will take you somewhere between 8 to 12 weeks to get that shipped to you. Wow. Think about that. Nearly 3 months to get your physical gold that you have a claim on. What's that tell you? That's the same thing, by the way, that happened in 2010 in the United States. Like, we're all asking, is there gold in Fort Knox? Well, in 2010, the Germans came back to the United States and said, hey, remember that gold that got parked with you guys at Fort Knox back in World War II, right after that? We actually need that back. It took like 6 months for the U.S. to get Germany their gold back. And importantly, the timestamp equivalent of the gold bars that Germany had put with us, they weren't the same ones. We couldn't deliver back to them the exact same bars of gold that they had parked with us. Wow. Does that mean it got sold probably over the last 50 years? Perhaps. The point is like the world is short gold at Fort Knox and London. And I think that that's what you're witnessing in the gold market. It's telling you that something's up the way it was in 1967, again, which you should all read on Wiki to give you a little sense of it on the Cliff Notes. And I think that that's interesting to us, right? That gold and silver are both short and the world is calling for the physical on them. And that portends really good things for Bitcoin too, because it will alert people to the sound money waves of the world has inflation, Fed's going to have to print, otherwise this thing would debt collapse. Okay, I've got gold and silver. I see them going from 3,100 an ounce and 35 an ounce respectively. Suddenly they're going to be at 75 an ounce silver and 4,500 an ounce gold when you wake up at some point in the next, call it 12, 18 months, 5 months, whenever. Then suddenly Bitcoin, then people say, gosh, that also sound money and scarce. And I know that the Citadels and Millenniums have been delevering and degrossing here in February and March of 2025. And it's at 81,000, let's say. But man, I need to have some of that. That's good value too. That's sound money. It's non-counterparty. Boom. And that's when we're off. And what's going to happen in the next one is, again, your friends and neighbors that have kind of laughed at you for being a Bitcoin cult person, they're suddenly getting the memo. And now you get that wall of money chasing a $1.8 trillion asset class. That's I'm oversimplifying, but I think that that's the flows of capital that we're watching combined with this macro backdrop of this debt thing that's going to play out. And the reason why the debt, I had a guy from London ask me that yesterday. He said, well, why can't the Fed just print and just keep it going? It doesn't have to come in a debt collapse. I said, precisely. That's what I agree with. I said, I think that's going to happen. I said, but what the world doesn't understand is that the average baby boomer is now 72 plus years old. And that 200 trillion of off balance sheet liabilities, a lot of it to that class of people, you can't just simply, those are not T-bills that can be refinanced and can kicked, and we'll put that off for another 3 years before we have to pay that debt. That's real cash coming due that has to go out. So I sure as heck hope the Trump administration cuts a lot without breaking the economy, because they're going to need that, because we've got all that off balance sheet stuff coming at us. And that's why Stan Druckenmiller thinks in the next 5 years we hit the wall, because the boomers are going to be 77. That money's coming due, and no one talks about it. And what's going to happen then in that case is the Fed's going to have to come in with yield curve control, because the deficits are going to blow out even more. And that's where we get this cycle going. And that's that whole point of Larry's point on the big print. At that point in time, even the Bitcoin people that laugh at us, the non-Bitcoiners that laugh at us, they're going to see it. Just like people in 1967 and then 71 saw it with gold. Suddenly gold was, I can't remember. I think gold was up 8x. No, more. I think, I think 8x more at least in the 1970s. For some reason, I had 20x in my head, but anyhow, it was a lot, and it was the best forming asset class. And you're going to see kind of that same thing play out, I think, in these asset classes again. It's going to be something akin to the 70s at a minimum. But again, it's not to be doomsdayer. It's just waking up to the realities of math and debt and where we're at. So.
It's so fascinating, and you're right. I mean, we can get pigeonholed into doomsdayers or chicken littles and things of that nature, and for all intents and purposes, this probably would have come down 15 years ago, in that '08 collapse, if they weren't just doing these massive big prints, alluding to Larry's book, right? And it's going to continually be bigger and bigger prints. I would love for you to unpack, just for the average person too, of the fiat debt trap. Like we're in this debt spiral that James Lavish talks about all the time. We're in this fiat debt trap. We've talked a lot about debt. It is confusing for the average person, and I get a lot of people that confuse inflation and thinking inflation is part of capitalism. Like, well, like you can't have deflation. The whole thing's going to collapse, guys. Like, you can't just have deflationary money or neutral money, Bitcoin, that captures deflation. That's impossible, because none of you will spend it. And so I would love for you to unpack, number one, why we are in this system, and why you are, Larry's writing books, why you have spent your life doing this and now educating people, running hedge funds, promoting these ideals of, hey, this is where the world is going. It might not be happening today or tomorrow even, but it's coming. This is the writing on the wall, because we live in this debt-based system, which everyone thinks that's just the laws of nature. That's just like first principles. Is like, well, you have inflation and you have to have debt, and that's not the case at all. So I would love for you to unpack why this is, why we have to talk about this. I guess probably the best way to say it. Why do we have to talk about this so much and prepare for these things? Why are we living in the system, and what is this system we're living in, this debt-based system?
Yeah, so you could argue the 1800s parts of it, not all of it, because I'm talking about 1850 onward, right? But then, look, we had the Civil War and we had Depression, so there were challenges in the U.S. But for good periods of the 1850s, you had deflationary economies because of the ingenuity that was happening, and the railroad era, and the immigrant classes coming to America, and all that, and you had this great growth. So I'm taking from an American perspective here, but so you can have that. This whole concept of inflation, I would argue, came about from all the money printing that really, you could argue, started to bail out from some of the depressions in the late 1800s, but then really kicked in the 1915 era, when, remember, the Federal Reserve was created to try and, basically kind of, you could argue, as a bank insurance policy of syndicate of banks to protect them and hold them together, to prevent bank runs and not having, kind of strengthened numbers, so to speak. If all banks are kind of together with this backstop Federal Reserve, you don't have all these mini bank runs and panics and fears like the late 1890s. So unfortunately, the Fed broke its charter when World War I broke out a few years later, and just said, okay, they're actually going to finance the war. And then, it really then financed, the rebuilding of England, right? America was lending so much money, and again, the immigration waves came into the 20s, and the 1920s had such great innovation, from autos to just so much innovation at that time, and I think that the 1920s were a real gangbuster period, and yet the problem was, it was again a levered bubble, and And then ended in 29, right? Because you end up with that same story. Debt grows. At some point, there's a credit crunch and a liquidity crisis. Stuff dries up, and it's like, oh, shoot, I can't pay my debts. And then it turns into a solvency crisis of, I'm not going to trust Brandon or GE or JP Morgan. I don't know if they'll get paid back. So everything locks up. So when you have those debt-based systems, deflation's the devil, and you can't have that. You have to keep inflating to have more money in the future to pay down that fixed amount of debt. And the game got bigger. And as I said about 20 minutes ago, like, then came the 1970s when we fully went off the gold standard, which at least that anchored us a little bit. And I think that's, like, think about it in America, the stories you've heard, like, my grandparents in the 50s, people didn't own 3 homes. They would take 2 weeks a year vacation, rent a place, generally speaking. I'm talking about middle classes, right?
Middle class, yeah.
America wasn't as rich. I mean, our parents, like, growing up, like, we didn't have a ton of money. Like, you weren't poor. We had plenty of, we never worried about food, but, like, you didn't have the luxury of, like, all these crazy things that we do in society in America today. And some of that's because technology came about and Microsoft and Intel, and that's all true. Like, we have innovated. So I don't want to be gloom and doom, but a lot of it is debt-based money after 71. Credit cards, coming home in the late 70s, early 80s, you can remember like 7 credit card applications in the mail every week in the post office trying to get you to borrow as a consumer. So it began, the consumption-driven economy, I would argue, and the boomers were then coming of age. And as the Fourth Turning book talks about, the boomers wanted to flex their muscles. Look how rich I am. I drive these fancy cars and BMWs. And again, it's not picking on the boomers. It's just the nature of that. Again, read the Fourth Turning. It's a great summary of that. And the boomers wanted to rebel against their Ward Cleaver and June Cleaver 1950s boring parents. They wanted to live. And so the consumption era grew, and Michael Milken in the junk bond market, and the consumption grew, and the stock market's going up. And here we are. We woke up with a securitization market then that allowed the housing crisis. We have been addicted to debt for 50 some odd years. And the question is, we've hit a cul-de-sac. And the question is, are we about to run through the wall of the cul-de-sac and the whole thing kind of turns into a mess? Maybe. Again, Larry and I debate that. Larry would say yes, in 3 to 5 years that's going to happen. I don't think that's crazy. I think that makes sense. But I think it's nuanced, right? It's a complex world, and it can be prolonged longer than you think, because they can keep playing games and people can be naive that they don't understand that this inflation is killing them. Like, I don't think America's woken up to that yet. I think we think it's Democrats and Republicans, but I thought it was interesting how Bernie Sanders is out there doing roadshows saying it's not about Democrats and Republicans. It's about the 90% versus the top 10%, the wealth gap. And to be honest, he's right. And yet he's not even running for office. He's just out there doing it. And I don't like Bernie Sanders, by the way. I don't like any politician, to be full disclosure. I'm an independent. I'm a Bitcoin party person, a libertarian. So I don't mean to offend anyone that likes, rights or left, but I think it's an interesting nuance that Bernie's pointing out. And I think it's more accurate. It's about the wealth gaps, and it's dialing back to that money supply and debt driven economy. So I've been long winded, but I think that, to me, that's the story of kind of where we're at, how we've gotten there, and why it kind of could rhyme with Weimar at some point, but it's nuanced, right? And this Bernanke playbook of deflation's the devil, you have to print, from the 1930s, that was the mistake of the Depression. That is the playbook that all governments will use, and that's why Bitcoin and gold are doing what it's doing. The question is, on this next crisis, that's where this will be different. This will be at the sovereign level, I think, as well. And I think that's going to be the challenge. So I feel like I've gone off in tangents. I don't know if I'm answering your question there, but I think I'm just trying to think about chronologically of kind of how we've got here over the last 115 years from the Federal Reserve's inception, how that turned into this debt-driven economy, combine them with the credit card stuff. And so a deflationary economy in the 1800s worked fine, but because of that debt-driven economy that really began 115 years ago, 110 years ago, we have been addicted to this concept of inflation is necessary. And to be fair to Bernanke, them, like, he's kind of not wrong. Like, if you have this kind of debt quantum, you have to inflate the hell out of it. And that's that whole Luke Gromen thesis now, that They have no choice. This austerity thing, actually, the plate, like Gromen's argument, it's got to, actually, we should go on to this. Larry and I were just having this conversation, and James and I were having this conversation the other day. Like, there's Howard Lutnick, I would argue, on this side that, that listened to it all in podcast last week, where he's playing and it's interesting, you can't dismiss it, which is if the U.S. cuts $1 trillion out of waste, and we use these tariffs to hammer people to say, Honda, thou shalt build factories in South Carolina, and we'll remove the 25% tariff on your car if you just simply guarantee that you'll move that there. That could work. Now, there's nuance there. Does Honda, though, send a fax to the White House that says, yeah, we'll build a plant in North Carolina by 2032? And you're like, okay, Howard, but is that really creating the job for the people that gave you the mandate or not? This is the things that I think we'll debate over the next 4 years. But I think that's what that looks like. If you see their comments overnight, Lutnick and them are implying that, look, if Honda and them simply, I'm just picking Honda as one, if they would build a plant in America, we'll remove that tariff. And so therefore, stock market, don't be panicked about April 2nd. We just need them to capitulate and comply with our policy. If you want access to the American consumer, you got to pay for it. And that begins with having your plants made in America and get these jobs back. Okay, that's Howard Lutnick and the Trump administration right there. I think that's interesting. And I think it's worth discussing about pros and cons of what can go right and wrong with that. On the left would be, I would call the Luke Gromen camp. His argument would be, I'm going to oversimplify. Howard, that's dangerous. You can't cut $1 trillion out. That's fiscal dominance that you are ruining. Lynn Alden's thesis. You're going to break the economy if you do that. And so austerity doesn't work when you're in a debt-based system like we are. You've got to inflate your way out. Luke would say that's your only choice. You've got to have massive inflation. And unfortunately, the Bernie Sanders wealth gaps, sadly, are going to grow even wider. We're going to be at each other's throats even more. And what's scary is at some point people are going to realize it's not right versus left, Dems, Republicans. It's 90% versus 10%. And that's your old pitchforks. And, God help you if you have a Bentley parked on some street, they're going to come and graffiti that, right? You're going to move into an era, I predict, about 10 years from now where Hermes bags and Bentleys are going to be gauche. Like you're going to want to have, as George Bodine talks about, you want to have good OPSEC. You want to keep kind of your wealth kind of private and don't show off. Don't flex your muscles like the boomers did in the 80s. That's one of those fourth turnings, right? And so I think that I'm going on tangents, but those are the two extremes. Luke, that you can only inflate your way out, no austerity. Howard, austerity combined with bring jobs back to America, build in America. And Howard would probably say, yeah, that is inflationary because instead of having labor making widgets for the automobile supply parts at $4.50 an hour, we're going to pay $17.50 to $19.50 an hour in the U.S. So yeah, your average cost of a car will be $75,000, not $40,000. Sad for you, American consumer, but at least you got more jobs. You could debate that and say, Howard, what are we doing? You're going against the laws of economics of guns and butter that we should outsource certain jobs to China to make parts at $4.50 an hour, not pay $19.50 an hour because that's inflationary, right? You could debate that. Reasonable minds could debate. And I think Howard would counter on this call where he'd say, no, we have to get jobs back in America again. We got to build. And again, that's a valid point. I think we as Americans need to start listening to each other better and understanding nuance and understanding that there's no right answer. It's not black and white. There's gray. And so we got to just get to a good debate of what's the best of all of our choices among that. How do we land the plane? So to finish this thought, to me, Scott Bessent, the Treasury Secretary, is in the middle of those two arguments. And Scott Bessent has laid out the 333 plan, which is jack oil production by 3 million barrels a day because he really wants to get oil down to the, JP Morgan had a piece out this morning that the marginal cost of oil right now, according to surveys out of the Texas Oil Group, is $51 a barrel. $31 a barrel. $31 a barrel is the marginal cost. To cover your operating expenses, though, to have positive cash flow, you need to have $60+ a barrel to make profits. But I think the one thing I learned in the distressed oil markets is when you get these recessions, those commodities like oil go down to their marginal cost and then slightly through it. So I would predict that oil probably would crash down if we had some nasty recession at $25 to $30 a barrel area, at least temporarily. until the market cleans itself up when everyone shuts in. But that takes time because people will continue to produce to get some absorption. But Bessent's point on the 333 plan is to get oil production up, to get that oil price down, to pick a number, $55 a barrel, to keep inflation low. Secondly, 3% real GDP growth, meaning we need GDP nominally to grow 3% higher than inflation. I think he's using CPI as inflation. So he needs a 6% nominal over a 3% CPI to kind of continue to keep this debt system we have together. And then the third is 3% of deficit to GDP. He needs to get to 3% of deficit to GDP by 2028 versus we're at 7% today, meaning you got to cut spending and waste and you got to grow your tax base. If you do the math on that 3% of deficit to GDP, it's roughly $380 billion a year that Bessent would say can come out of the economy. And Howard's out there this past weekend saying, no, we're taking $1 trillion out by May. Well, that's why your stock market's selling off, I'd argue, is because people are worried about that, saying, holy cow, are they going to cut into muscle and end fiscal dominance? And is Bessent more right? So I've been long-winded, but I think that's the way I frame it in my mind of those three camps of Lutnick and Trump and their plan, Bessent in the middle, and then Luke saying, you're in a global debt system. Trump and Lutnick, you're going to break it, and you're going to see all of this unwind, and then therefore yield curve control will come in, and Bitcoin and gold will take off. As you can hear me, I'm kind of open-minded to all views, and I'm kind of in the Gromen and Bessent camp a little, of not doomsday completely, but a little bit closer to that, because I do think ultimately Luke's going to be right. I just think Luke's going to be right over a 10-year period. I don't think he's going to necessarily be right in 3 months. So I think that's how my brain frames what the market economy looks like right now. Flow of funds matters. Tell me what the Federal Reserve is doing. Are they helping out the Trump administration as they cut $1 trillion out to help flood the system? You could debate that. Does the world need any more debt? Are we saturated and won't take it even if the Fed brings rates back to 2%? Again, this is a gray area, but those are the three kind of tenets as I think about it of studying markets and economies today. So I don't know if that's what you asked, but I just kind of want to lay that out there because it's something I've been thinking about this week.
No, that was great. It was one of my other questions I wanted to ask you at some point. So you kind of, because the first one we were talking about why are we in this system in the first place. So you beautifully went through chronologically for the last 100 almost 50 years, I guess, really of what it's been. Well, yeah, I guess it has been 150 years. And this, which goes back to, then you led into, Gromen coming in and talking about what Trump, what Lutnick, what these guys are kind of thinking, which a lot of what we heard is that late 1800s playbook. I mean, the tariff talk, sound money, getting back to this pre-Federal Reserve, free banking era, really, where you have competition just throughout, trying to reshore jobs, have the manufacturing here, this industrial boom. Yeah. And then you laid it out perfectly with just the kind of the three different camps, which is going to be absolutely fascinating. So that's like the crux of everything we're dealing with, and why this is all so important, because this is what we've been leading up to for literally at least 110 years or so, 112 years since the Federal Reserve came in. But this is a wild time. And it's funny too, because like you said, Ben Bernanke, they wrote the paper in 2002. The IMF had their paper they wrote in, I think, 2012. And it was all about, deflation, like you mentioned, can't happen here. And this is one of my initial questions to you was, I've had family members fighting me about, like, you can't have deflation here. You can't, all these different, business school people, and it's funny because like you said, Ben Bernanke's right. Like, those people are right. You can't have deflation in this inflationary system we're in. Like, those two don't mix. But it's like two ships passing in the night. It's like we're talking different things. Like you and I sit here and talk about the way things should be. And to a large extent, those people are talking about the way things are. And then you outlined it with this fight of like these three camps of how everything's trying to play itself out. So it's fascinating because this to me wraps up like 150 years of all of our study, monetary history, all into like we're in the fight of our lives right now. It's fascinating.
Well, and to me, the world is always gray. It's not black and white, right? It's nuanced. And so let's stick with these three camps. I think with Trump, and you heard Bessent say it on the All In podcast last week. So they did one with Lutnick and Bessent. They're definitely, everyone should go listen to it. It's
great
really
interviews,
worth your time. Yeah. But Bessent made a good point, which is, look, if we do this plan that Lutnick's laying out, and suddenly we're making widgets at $19.50 an hour outside of Ohio or Detroit, and look, you from the Midwest know this better, where like we're just a bunch of people that are whining about the stock market. Some of the middle of the country would say, stop whining, LA, Boston, New York people, Chicago. Like, we lost jobs. Like, I'm watching these illegal immigrants getting better deals than I am getting. And I lost my job that went to China.
Yeah.
And the administration is saying, we hear you. You voted us in. We have a mandate. If this means that the stock market has to go down 20 or 30%, like right now, we have to do that. We've got to go get those jobs back. And yeah, that means inflation. You're right, David, that 10 years from now, $17.50 an hour widgets are more expensive than $450. Therefore, your price of your car went to $70,000, not 40 on average. Well, that's okay because we're just back in an economy where Walmart's profit margins aren't as big, and you who own stocks and assets aren't quite as rich and wealthy as you were. We're trying to solidify the bottom 90%. And you could argue that, look, that's not a crazy thesis. Like, there's an argument to be made that they're right. And now let's go over to Luke's tent. And Luke would say, yeah, that's great, but you've got a debt-based system, and you're going to blow this up, Trump, in that. And therefore, you're going to have to be forced to come in with yield control to keep the debt at bay. Either way, like, I kind of agree with both camps. I see it. I think they're valid responses, and I think they all have to be weighed. But it's why I just kind of come back to, like, highly confident that, like, all roads lead to monetary debasement and printing because the deficits are going to swell under either scenario. And that's where we're at. And I think Scott Bessent's in the middle trying to be like, okay, everyone settle down. Like, we need to do this slowly and gently. And this is how we play it out. And he's very refined gentleman. And I kind of think like that's a good temperament to have too, because otherwise you're going to have this, dueling banjos. I think that's where we're at. I think we got there, over the last 150 years, certainly over the last 115 for sure. I think acutely we got there in the last 50, and then super acutely in the last 25 years, as Michael Howell was pointing out, right, where debt has gone up 10x in that period globally since 2000. Like, that's stunning. It's that same chart that we showed before, that it took 220 years for the U.S. to get to like 11 or 10 trillion dollars of debt on its balance sheet. 220 years of our country, and then it took only like 10 years to add the next 10 trillion. Like, this is that parabolic move that happens. This is the law of compounding, and that's also underappreciated by the average American and the average citizen in the world, that when you're in these debt-based systems, like how fast this thing can compound on you, where you literally could go from 36 trillion of a global U.S. national debt to like 52 trillion faster than you can imagine, because of the laws of compounding interest upon debt, upon leads more debt, and compounding deficits leading to just more and more. And here we are. So, like, I think that's not to scare people. It's really to say you're in one of those fourth turning periods of history. Everyone should go, at a minimum, go to the fourthturning.com and read the cliff notes of it. But at a maximum, go read the book. We're in one of those. We truly are at an inflection point. It probably started in 08, and those turnings happen every 80 years. So it's 20 years. Theoretically, we're 15 years or so into this turning. That's where Larry comes out, that in the next 5 years, and I would argue Dalio and Druckenmiller, that in the next 5 years, this all comes to a head, and you will have some sort of a fiscal crisis. And but it's not to scare people, it's to just say, like make sure you're being wise. Like, is your debt in check? Is it on a good asset? To me, the only leverage you should have is on a piece of good real estate where you can fix it out 30 years at a low rate of 4%, something like that. And if you can do that, then that's at least a stable asset. I don't think any volatile asset, including Bitcoin personally, should ever be levered. That's my opinion. I know that's heresy to some people, but I think given where we are at in the growth phase of Bitcoin and the volatility, you got to be really careful with leverage. There will be a time in a decade or 20 years that it will be a less volatile asset, and it might be okay to then put some leverage on it. Indeed, I think that's where the world we will be in, where MicroStrategy is the JP Morgan of the world as the leading financial service business, and Bitcoin's a major accepted collateral asset that you can borrow against. So that's just trying to summarize there.
Beautifully said. So we talked about obviously a lot of this and how fiat has distorted all these incentives, created these debt cycles. It has changed our human behavior. Obviously, the boomer class we've talked about, which, you know, like you said, not to pick on them, they just happen to be the people at that given time, and it's kind of just distorted how we've grown our debt. And looking back, it's kind of like you alluded to in a way. You didn't say this, these are my words, but it's like a modern dark age. Like we pulled a lot of this consumption into the now over the last 50, 75, 100 years because of this money printing. And then you're going to look back someday, because I always think of this, and I feel like people are going to say 100 years from now, man, you guys were in a modern dark age. Like you guys could have had so much more if you would have just been on sound money standard, and you limited yourself, and it was papered over by literal money printing, but also, like you said earlier, the technology boom, things like that kind of masked a lot of the ills of society. Like you said, WTF happened in 1971, the amount of divorces, broken families, there's so many attorneys, you know, like all these things where society, you know, the level of the quality of food has gone down, all these things since 1971, like you've alluded to many times throughout this talk, which I think is all these incentives that have led to this. So I would love to transition. So not only that, but, you know, just destroying people's wealth, you know, some of the obvious things because of inflation and people thinking that we need it in capitalism, which is the antithesis of capitalism. But anyway, so Bitcoin itself, I would love for you to touch on why Bitcoin. So we talked about all these things, which are so important, and it leads up to Bitcoin again. Why is it the apex asset? You know, we touched on in the beginning a little bit, but why, like the properties it contains, what sets it apart from gold, where gold was the best thing we had for 5,000 years, but what sets it apart from gold that gives us this true opportunity to actually build a system, an economic system, have capitalism on top of that monetary bedrock finally, and do it globally? What sets Bitcoin apart? And then I'm going to get into a question about the other cryptos and other currencies next, but I would love for you to start unpacking this a little bit.
Yeah, I mean, I think it starts with just that knowing that there's my pup here checking in on us. But we have, again, it starts with non-debt money. No one controls it. No one controls Bitcoin. It's the only you know, again, gold and Bitcoin theoretically are the only non-counterparty money. Now, the problem with gold is that, well, ultimately, look, if gold prices go to 7,000 an ounce, I guarantee you that the supply growth of gold that's been running at 1.8 to 2% a year will go over 3% at least. I don't think it'll go to 7% because the world truly, we've underinvested in the whole world, and there's not much gold to be found in the world. It's a scarce asset. Bitcoin, by code, by definition, that no one controls, it's mathematically programmed on autopilot. It's fixed. It's fixed supply. It can't continue to grow, and so you know it's set at its supply issuance, and you've already issued 19.8 million out of 21. So that's what makes it unique. No one controls it. The scarcity, the durability of it, the fact that you can pick up your wealth on your phone with your 12 seed words and run to the border of Switzerland if something were going wrong in the country that you live in, or the border of whatever country you want to go to. You are self-sovereign then. And so that's that non-counterparty money thing that we keep talking about, that's going to matter at some point in time. That will be your flight to safety. And the fact that you can buy it on your phone, and it's so easy for one of 8 billion people in the world to do it. You don't need a bank account. You don't need approval from Charles Schwab. You could be the poorest person in the world, but if you've got some money and you had a phone, and I know that sounds counterintuitive, but like 85% of people in the world have a cell phone. Well, even in sub-Saharan Africa, there's a lot. So anyone has access to be self-sovereign, to save themselves, to store their wealth that they worked their hard labor on forever. And who is a government or anyone to tell you what you should do with your wealth? Why do they have a right to that? And I know that sounds like a hardcore libertarian argument, but like that's what the founding principles of this United States country were. The Constitution is all about libertarianism and a republic. And Article 10 of the Constitution still says in it that only gold and silver are money. Again, go back and just review Article 10 of the Constitution. Like, there was a reason. They were worried about, they knew about the history of the fall of Rome. They knew about the history of the fall of China in the 1000s, that if you overprint money in debt-based systems, they break. It collapses. The founding fathers were acutely worried about exactly everything we've talked about on this call today. And that's why gold and silver were the only things denominated as money. Well, now Bitcoin's the new modern version of that. And it's better because of those reasons I've mentioned a minute ago, of that no one controls it. It's pre-programmed. It's the scarcest asset in the world, and you can take it anywhere and anyone can buy it. Again, Bitcoin equals fairness is always the thing that comes to my brain, or it's the truth, right? And so that's what I think sets up for this backdrop of, not that when things hit the fan, I don't want to be doomsdayer. It's just, this is the nature of math and debt and demographics. One more demographic. The average worker aged 25 to 64 in the US, we had 2.5 million workers for every retiree just 10 years ago. 2.5 workers aged 25 to 64 for every one retiree in this country.
Wow.
That's down to 1.4 workers for every retiree in just 9-10 years. Like, that's stunning, right? Some of that's the birth rate because people can't afford it and people are getting married later. But some of it also is just like, a lot of challenges we've had in society of people leaving the workforce and drug issues and all that. Like, we have problems, and that's another reason why Druckenmiller and them and Larry are convinced that this will happen sooner than like 10-year area that I say. It's like 3 to 5, and I think they're possibly right. So to answer your question, stay on topic because I can go off on tangents. I think Bitcoin is the soundest form of that and the easiest form. And again, I think there's going to be this moment over the next 5-10 years that you're going to see all these regular people having to come buy these sound money assets. In particular, the $300 trillion of bond money. I think a lot of that, literally, I always say simple math, like 10% of it, $30 trillion will come chasing this $1.8 trillion asset class of Bitcoin, and call it a 10 to 16 trillion asset class of gold. Well, that's a massive wall of money chasing scarce assets. Well, that's only 10%. The reality is it'll probably be a hell of a lot more than that of the 300 trillion bond money. Equities, ironically, probably will go up, right? At least your inflation hedge businesses, your software as a service businesses that are reasonably valued that still have pricing power, right? If you go read the Warren Buffett letters from the 70s of how to invest during an inflationary period, you can distill it down to two things. Buffett always said, buy businesses that have pricing power, can pass those inflationary costs through to the consumer because what they make is so necessary, a GE refrigerator perhaps, or what have you at the time. And the second thing is a low capital intensive business, a company that doesn't have to keep spending massive amounts of CapEx to rebuild plants and repair and maintain the plant because the inflation was killing them on the CapEx. Well, software as a service is probably the definition of that in our modern times. So find the Salesforce.coms or the Google and businesses that you can't live without, whatever it might be. Maybe Google's a bad example, but, maybe, the equivalent. That's kind of, I think, what we're going to set up with is equities, the good ones that are low capital intensity and have pricing power, they'll do well. And Bitcoin and gold, though, in my opinion, will be the best performing asset classes in the world. And Bitcoin by far will compound at levels that we can't imagine, or you can imagine. You've just watched it, I guess you could argue, over the last decade. So I just think Bitcoin will continue to compound as well as it has.
So transitioning just a tad, I want you to touch on altcoins, cryptos, because this is something that continually has obviously been a big talking point just in the last month or two since the Trump inauguration. We continually have these debates in this world. People seem to think that Bitcoin was the start of the crypto world, and to me, I look at it as that was the end. That was the end of the cryptography of value over the internet. For decades, people have been trying to figure this out and find that. And it's once you discover fire, once you discover the wheel, you can't discover fire again. It seems simple to me. It's a protocol. I would love for you to unpack this, why we continually are having these fights and people keep coming into the altcoin or crypto or meme space and going that route instead of just, hey, this is sound money. This is going to go up in value over time and shield you from everything you just have talked about over the last hour. This is going to shield you from what's happening here. It's completely outside. It's a lifeboat off the sinking debt-based fiat Titanic. Here it is. It might be scary. It's a small little lifeboat in the dark ocean right now, but it's your shot instead of we're trying to rearrange deck chairs on the Titanic.
Yeah, I think, and again, my brain always thinks chronologically just to kind of simplify, and so I would argue that, Bitcoin's the original. It's the Coca-Cola And then you had the Tabs and the Dr. Peppers and the Mountain Dew knockoffs all come along after, which are the cryptos. Why? I would argue because chronologically, the Fed kept rates low since 2010. We blew another speculative bubble, just like the one we had that led to the housing crisis. This time it's the all everything bubble. And that led to speculators saying, okay, well, I got to beat this inflation somehow. I better go buy Solana and Cardano and Ethereum. Now, that's not to totally rain on the parade of people that are crypto fans out there. I'm sure there will be 5 or so or 10, 12 technologies in crypto that will be of perhaps value on the other side here at some point. I have no idea. To be honest, I'm not I tend to be more of a Bitcoin maxi probably with a lowercase m, but I'm not, again, it's the old classic phrase of we should never say that the world's black and white. Often you say the word, I wonder about this, I wonder about that.
Mm-hmm.
To me, that's the way to attack the world and think through things. But I wonder if the speculative bubble of the last 15 years, engendered by the Fed, has led to this crypto bubble, combined with greed always will persist. And Sam Bankman-Fried comes out and creates FTX and FTX, of the world or whatever it might be. And I think that those cryptos then can survive so long as the speculative bubble and the musical chairs keeps playing, right? The music on the musical chairs game keeps playing. Well, again, during that next liquidity crisis, though, to me, a lot of that stuff's going to come home to roost. Now, I think it's interesting, though. I think you should talk about stablecoins for a minute, because clearly the Trump administration wisely understands that stablecoins are part of the government's solution. In the absence of foreign buyers of U.S. Treasuries, the stablecoin purchaser is a massive buyer of T-bills, not bonds, though. That's an important distinction. Because, Tether owns more, is the sixth largest
really quick, David,
treasury.
Difference between, just for the average person, T-bills and bonds, why it's important.
T-bills are kind of anything inside of, call it 2-year treasuries and inward, with the U.S. government's been having to finance themselves with. Treasury bonds are kind of 2 years and beyond, 2 years to 30 years. Now, important notion that around maybe 2017, Steve Mnuchin, the Treasury Secretary, tried to float the idea of issuing 100-year bonds, treasury bonds, to try and finance the government, which was smart, right? It's the same equivalent of those that own houses in 2020 that were refinancing at 2.75% on a 30-year mortgage. That's a brilliant arbitrage trade, so long as you're going to stay in that house for 30 years. If you're an upwardly mobile family, though, or you're going to move across the country, well, then that probably doesn't make sense. But if you're a family saying we're dug in for 30 years here, it's a great arbitrage. You just compounding for 30 years at a low rate. Well, they tried to do that, 100-year bonds, but there was no demand for it. And no one wanted to take the inflation risk or take on the government balance sheet for 100 years. And sadly, over the last, 10 years or 5 to 7 years, let's say, there really hasn't been much demand for 30-year bonds because of that same factor. People don't want to take exposure to the U.S. government's balance sheet for that long, and the inflation is uncertain. So Yellen was forced to go to the T-bill market to really finance these massive amounts of debt. And so now we're at a point where now $9.2 trillion of T-bills matures this year because we're just refinancing on the short end. And Scott Bessent's goal is to try and term that out to at least 10 years. But even he's having to keep going to the T-bill market now because there's no demand out there at the 10-year. It's part of why I'm so highly confident on Bitcoin and gold doing well, because I think the world realizes it, that the inflation is going to persist. The Fed has no choice. They're going to have to print. And no one wants to take long-term exposure to the inflation rates and or the U.S. government's balance sheet. So it's already begun, in my opinion, this bull market that we're describing ahead of this next crisis. And so back to the point, like Tether is the 6th largest T-bill buyer in the world and owns more treasuries than Canada. So the stablecoin bill is front and center, the first thing that Washington's working on right now. And you know damn well that's going to get approved because they need it.
Yeah.
What I wonder on stablecoins is ultimately there's massive demand for stablecoins, because think about Argentina. When stuff was hitting the fan there over the last 2 years, people want dollars still. They don't run to Bitcoin necessarily yet. or gold even, because the average person down in Argentina knows dollars, US dollars. Well, stable coins are a way for you to buy it right on your phone and you have it immediately. You don't have to be a wealthy family here in Argentina with a Citibank bank account in Miami. You too can protect your family's hard-earned labor savings, store your value in a stable coin that's tied to the dollar. Okay, that's real. That's why I believe Van Eck and them are right. The stablecoin market's going to grow massively. Even the state of Wyoming's talking about issuing stable coins this week. So what I wonder about, though, is think about it. A stable coin is a claim on a dollar. A stable coin is a claim on a treasury bill. What if we end up in a world where the treasury bills and the dollar are the volatile asset and Bitcoin and gold are the stable assets, and average American consumer realizes that? And that's coming to a theater near you at some point in the next decade, as we're talking about. So what happens to stablecoins then? In my opinion, Bitcoin becomes where all the stablecoin money gets sold off to and goes to that. It's like the breaking of the buck in 2008. No one thought these money market government guaranteed things would break. Well, it did. It broke the buck. And that's when everyone panicked. That was one of the chapters of the 2008 crisis where everyone then ran more and more to safe assets. So, you're going to see that again on stable coins. I can't get that excited about stable coins. It's also, are you really hedging against your inflation? Stable coins is just like a pit stop on the Indy 500. It's just to go in and get a car change if you're going from this crypto to the next. In my opinion, it's not a way to store your value. Bitcoin and gold are unique, as we just talked about earlier, and I think that ultimately more and more people see it. That's why I have no patience and time are going to play out in these asset classes to work. So staying on the crypto theme, which technologies will win, I don't know. I will say that they are not stores of value. I think even your average crypto speculator knows that Bitcoin is the store of value game. That crowd will come rushing into Bitcoin too. They just think that they can wait because the music's still playing, but they don't realize that they're playing a dangerous game, that the music may have stopped for their crypto and they should be getting the heck out of it. That's kind of how I see it. They're not stores of value because Sam Bankman-Fried, or even in Ethereum's case, the top 5 guys at Ethereum control 64% of the money supply. That's not sound. That's not, gold at least is a scarce asset, that they're not finding more of it in the world. Bitcoin we know is scarce, right? That 51% of nodes would have to agree to change the protocol. But the beauty of what Nakamoto created is the incentive system doesn't align itself for them wanting to change the money supply of Bitcoin because they're cutting their own nose off. So it's a brilliantly structured setup on autopilot. Again, digital capital built on top of TCP/IP that will be the digital version of capital or digital gold as a store of value, and it's the scarcest asset in the world. And when you get into these crises, literally, so much money is going to come flying at it. It will stun us how many standard deviations away from the power law that Bitcoin moves to in any crisis like I'm defining or describing here. I truly believe that. Like I really think you're going to see like a 7 standard deviation move. I don't know how long that will last, because I think a lot of Bitcoin hodlers will be selling, because then they're going to say, well, you know what? Geez, I'm worth X amount of money and I should diversify. And remember that place in Miami when we wanted to buy? Well, it's marked down 55% from where we were looking at it. Maybe I should go sell a little Bitcoin and buy that. Or maybe I should go buy Salesforce.com or Apple, knock on its back. Apple still has an ecosystem, and now it's got a 15% free cash flow yield here at $72 a price. And Apple was just at 280 just 2 years ago. I think that's what that will look like, and how things will play out. I don't mean to tick off a bunch of crypto people, because I'm not arrogant enough to say that, but I think we should all agree, even the crypto folks, they're not sound money stores of value. They're interesting technologies, perhaps at best, and they might have use cases, some of them. But like Bitcoin and gold, it's a different game that you're playing, and you just need to understand that. And so then one last point. So what James and I with the Bitcoin Opportunity Fund, we're trying to invest in public and private businesses in the Bitcoin space, because our belief is that when Bitcoin grows like we're talking about, then not only the network effects then kind of begin to proliferate even further, where so many use cases of this store of value collateral of Bitcoin start to grow. Worst case, it's like use cases will be MicroStrategy is the leading JP Morgan bank of the world, and Bitcoin's the major collateral, and they're able to borrow against that to go off and offer all sorts of business lines, from insurance to banking to what have you, lending, whatever. And Bitcoin's a less volatile asset at that point in time of its life cycle. And so But I think there'll be other businesses all around this Bitcoin ecosystem, picks and shovels type businesses that will be fascinating to watch, custodial businesses, things like that. So I think that's ultimately where this plays. Where I'm usually wrong is it takes longer than I think. And that's why you hear me being more conservative with 10 to 12 years. For instance, in 2017, I could see that this distressed oil and gas sector was a great investment. I thought by 2020 it would clean itself up. I was wrong by a year or two. It took longer. Why? Because COVID happened. Well, I didn't see that on the bingo card. I didn't think that would happen. Well, it did. And life happens. But like, you're not wrong. By 2022, your IRRs were phenomenal from all the distressed debt you were buying in the oil space down at 20 cents on the dollar. And your IRRs are phenomenal. It's the same thing with Bitcoin and gold. Like our IRRs are phenomenal, whether this takes 3 years or 10 years. This will be some of the best asset classes, but Bitcoin is like no other. It's unique. So I'm just trying to empty the desk drawer of my brain on how I think about things chronologically playing out and how I see. Now, I don't think anyone should put 100% of their assets in Bitcoin. I think you need to be diversified. But I think a much larger overweight than you know about should be allocated to sound money assets right now, like Bitcoin and gold. And everyone has to define that for themselves. Is that 40% if you're younger? Is it 6% if you're older? How are the rest of your assets set up? How liquid are you? And things like that. So, and that's the other beauty of Bitcoin. Like, I actually like Bitcoin better than real estate right now, for sure, because it's liquid. You can change your mind on a dime. If you get in one of these recessions, you might be stuck with that house that you overpaid for, and now they're taxing it. Now the roof is leaking and it needs repair. Like, Bitcoin is going to be the soundest value. Nothing will compound like it. So, it amazes me that more and more of the people haven't seen it yet, because I'm more in that camp that only like 3% of people I think are in the Bitcoin ecosystem at best. I'm not quite there at the 10% to 15% crowd of some people. I think it's far lower, and you can kind of just feel that talking to people on soccer sidelines and at school event type things. And I think we're way early, and I think that, but it's coming. It's coming. I think you probably need a massive. I hate to say it, you probably need a massive equity market correction for people, your average consumer, to really understand what we're all talking about here in this Bitcoin space. And then the money printing will begin, as we talked about, and then you get in these 1970s cycles, or perhaps something far worse than that, where now suddenly they're like, geez, should I be buying? And look, there's definitely, think about the most anti-Bitcoin person when those people come to you in 4 or 5, 7 years and say, okay, I'm buying here and it's at $1.5 million or something, you're going to be like, okay, time for you to diversify. It's time for you to go look at that Miami property that you wanted to buy. You should probably peel off a little of your Bitcoin here and go buy that, because Mr. Jones, who used to make fun of you, is now asking you about buying it. Well, it's now a crowded trade. So that's how to think about it. But I'm a contrarian I'm showing you I'm a contrarian by nature. I feel like you go where they're not, right? And that's why I feel really good about Bitcoin. Well, actually, one more story. I'm long-winded, but I was just at a Harvard Business School conference. It was a family office panel. I'm with a friend of mine from HBS that's a Bain Capital Gap here in Boston. And it's actually interesting, because the Bitcoin Opportunity Fund, he's introduced us to a deal that we're actually advising, this private deal we're going to invest in. We're advising the company that he's introduced us to into a Bitcoin treasury management strategy. Our Bitcoin Opportunity Fund is advising. But his name's Rob, and so he's sitting next to me. Family office panel's up there, and they start talking about inflation, about 5 of them. New York large CIO, family office CIO, and a bunch of other Boston ones and other Chicago CIOs. And they started talking about inflation, and they all agreed, yeah, this inflation could be massive. Not only the tariffs, but the money supply. And I'm like, oh, okay, they get it. They see everything we're talking about. So I raised my hand, actually, in the Q&A, and I said, yeah, I got a question. I said, you all talked about inflation. You all seem to agree that it's there. I said, how many of you own gold or Bitcoin to hedge against that? The New York CIO woman steps up and says, yeah, we've been talking about gold a lot, but we don't own any. And I'm like, okay. And literally, to a man and woman on the panel, it's like they snickered at me and laughed when they're like, Bitcoin? Like, it's child's like, you idiot, And I turned to my friend Rob. I said, we are so early. That's exactly what I wanted to hear. Like, it's like perfect answer. Because if those people were like, yeah, we own Bitcoin, I would have been scared, like, oh, shoot, like, it's getting late. like we're so early, Brandon, and it's like I kind of
man.
laughed at myself. That's the contrarian that I am, though, where I'm
Yeah.
like, this is awesome. Like these people are going to be like coming up to us in 3 years, being like, "Hey, I see that you own Bitcoin and gold," and you'll know, ding, 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 like, it's late here. Bitcoin's at 1.2 million a coin. We should be thinking about what are we doing here. That's how I think things play, and that's where I think we're at. People are becoming aware and awakened to the risks, but they're not ready to pull the trigger. They won't be ready till they see probably a 30% correction in the stock market, think '08 like, and then they'll say, gee, maybe those Bitcoin people aren't nuts after all. And that's how I think this plays out chronologically. Um, so I love it. I love that setup. When everyone hates it, I love it.
Yeah, it's beautiful. And it's funny. I mean, we obviously in the Bitcoin crowd, this is something that we talk about how Bitcoin has changed us. I wasn't in the school of thermodynamics and really thinking about all these things. Natural law, obviously, first principle thinking was more of my world. And then we talk about sound money and talking about, just past monetary historians and going down that road. But yeah, I always likened it to with the initial thing we were talking about was altcoins, and you are so good at chronologically kind of laying all these things out. And I always have told people, and it's like, oh, you're a Bitcoin maximalist. Like, no, I'm a freedom maximalist, but with a caveat. I contend that we should be fighting for monetary bedrock, Bitcoin, before we start going to the casino and having fun and doing all these, fun and games and tech plays and whatever. I don't care what you want to do, and I don't want to care what other people are doing. But when we're messing with the monetary layer, which messes with all of us and the incentives of society, that's when I have a problem. So go have fun all you want, but let's get this battle done first with the monetary bedrock. Then go have fun. Once that's done, go have fun, do whatever you want. Let's not put the cart before the horse. And I think that's my only contention with all of these things, and just knowing
Well, sorry to interrupt. I love your point on freedom, right? That because you're right. Like, and at the same time, that's why I too say I'm a lowercase m Bitcoin maxi,
Mm-hmm.
because I believe in freedom of choice. Like people
Yep.
I'm a libertarian at heart, where people
Yep.
have the right to do what they want to do. And think about it, Brandon. In 1849, there were all sorts of bamboozle, swindlers out there in the far west trying to sell picks and shovels, or trying to sell
Yep.
you on this
Yep.
some land here that has gold on it but didn't. You're going to get that. You had that in 99 with XYZ company changing their name to such and such internet.com because they
So
wanted to
true.
get their stock price up. You see it now in the Bitcoin space with
Yeah.
GameStop, right? Like saying, well, we don't have a business, but now look, if GameStop's smart, they'd pivot to the MicroStrategy strategy and say,
Right.
shoot, he's right. We got to go all in. That's an interesting thing to watch. Are they going to buy? They basically have $6 billion of cash now on their balance sheet after pricing the convert last night. What percentage of that are they going to put to work in Bitcoin and try and transform their business into a future Bitcoin bank? Like if I were them, I'd go all in the way MicroStrategy did. And it's interesting how that CEO Ryan Cohen's been meeting with Saylor over the last few
Yeah.
months. So I think that there's always going to be swindlers in any bubble, whether it's 1849 or the 99.com or now in this last 15 years of the crypto bubble, because it was a bunch of swindlers saying, I too have gold here. I too have .com in my name. That's what I think of crypto. And I think that there might be 5 to 12 technologies of crypto that survive and are good and sound technologies. Those are not stores of value. And so I'm a lowercase maxi in the sense that everyone has the freedom to do what they want. And unfortunately, some are going to learn hard lessons like we all do. We all make mistakes, right? Of, me in high school prom telling the pretty girl that I think was hinting me to ask her to prom, saying, well, I said, no, you're not my type, because I was afraid of rejection. Well, boy, that was a mistake. I really wanted to go to the prom with her, right? Well, we all make mistakes in life of things that you shouldn't have done that you did, and things you bought that you shouldn't have, whatever. That's how we all learn. And I think that we can't stifle it, but you got to regulate it. You got to regulate. I think that's the good thing that the Trump and them are doing, is trying to put some regulatory clarity around cryptos. And so far, I like the fact that David Sachs seems to get it, that crypto and Bitcoin are completely different things. I was glad to see him refining things at the Bitcoin summit, the digital
Mm-hmm.
asset summit, from versus Trump's true social policy that previous Sunday.
Yeah.
I think David Sachs is a steady hand. I think Scott Bessent
Yeah.
seemed to be a steady hand. I don't know them, but it seems like that. So I think that this is just the nature of speculative bubbles, but figure out the signal versus the noise. In 1999, it was Google and Amazon were legit internet businesses. Salesforce.com was a private company developing, about to take this internet thing and make this thing called the cloud, and take advantage of take advantage of this thing called the cloud then to build a business around it that was an unbelievable business that Salesforce built. The same thing is true here, that there will be businesses built and Bitcoin will be the sound one. It'll be the Google, the Amazon, the Salesforce of this era that is the signal, not the noise. And I think that, 1849, the equivalent would have been home stakes mining was, the great miner of its time, whereas there were swindlers that were telling you out there that it's not. And then, by the way, in 1929 through 35, the best performing stock in the world was home stakes mining, because when they banned the ownership of gold, the miners themselves is what everyone ran to. Again, same concept here of what we're trying to do with the Bitcoin Opportunity Fund, that if they ever 6102 Bitcoin, well, at least we're owning companies in the space like a home stakes equivalent that can outperform tied to the Bitcoin ecosystem over time. So I think that, I don't know, I'm rambling and just giving you some thoughts, but I think freedom's the right choice, and that goes both ways. And it's beautiful that you're preaching maximalism, because you're right. It's our duty to tell people what we think is the wise investment, but at the same time, you got to let people make mistakes so long as it's within legal bounds and regulatory bounds. So I just want to build on your point there.
Yeah, no, and if you're good, I've got a couple more for you before we wrap here. This has been such an awesome talk, David. This leads me right into what I wanted to kind of go to next, which was the Trojan horse and your thoughts on because people come to this objection of, well, why are you trying to regulate us? Let the free market decide. Now you Bitcoiners are all cypherpunk and, anti-government. Now you're all in bed with the government. Now you're trying to, so it's this objection that keeps coming up. But again, correct me if I'm wrong, but wasn't the whole point, again, to build this monetary bedrock outside of government's purview, but governments would have to acquiesce to at some point? That to get the Trojan horse to be effective, you got to get inside the city walls. And that's 16 years later. I mean, it took gold, hundreds of years, really thousands of years to really ascend to this position. And in 16 years, largely because of the internet, we can reach 8 billion people very quickly now. You have this monetary asset, Bitcoin, that is now ascending very, very, exponentially quickly to this prominent place in the world where everyone has to talk about it. What Trump did, that got slapped down on every president, prime minister, dictator's desk in the world, and said, hey, look what's going on. Was that not the goal the whole time? I know Satoshi and Hal Finney, they wrote about stuff like this. So correct me if I'm wrong, but I feel like this is the game playing out, and the free market is deciding, because right now we are the free market. We're talking about the ills of, hey, if you go down that road, might not be a great outcome. But if you go these ways, you might have a better time. They have stronger properties, stronger incentives built, in digital stone. So was that not the whole game the whole time, is to get the Trojan horse inside the city walls?
Yeah, it could be. So again, like one of the things I always loved about business school is you'd have this case study for an hour and a half, then you sit around with your classmates and debate, everyone raising their point, and you get so many interesting views, right? And that's why I always say the world's gray; it's not black and white. But let's build on each other's points, because we all have interesting perspectives, and that's possibly one. I've had two clients text me in the last 2 days saying, this was an NSA project Bitcoin and this and that, and Saylor might be involved, and you're like, okay, I'm not sure I agree, but interesting. I want to listen and hear what people think and that. And so I don't know, was it a game plan again and try to Trojan horse? I don't know. I like to personally think, when I put my head on the pillow at night, that the Hal Finneys, Adam Bax and them, PayPal, everyone was trying to get digital capital, and Satoshi Nakamoto and them finally kind of cracked the code of eliminating the double spend and Byzantine generals problem solve. And suddenly it's like, hey, actually this thing could work. But as Jeff Booth talks about, you can have speed and security, but something has to give on all the triangle that he identifies. Like what you give up on Bitcoin, though, for the secure network is speed, right? Every 9 minutes as opposed to every millisecond. and Ethereum of the world or cryptos will say, well, I can do it every millisecond. But it's like, but you're not secure necessarily, and you're centralized. And oh, by the way, you're not a store of value. And so I'm not sure all roads, it's not a real settlement layer, Ethereum, when we live in this AI world in a decade or 20 years from now, because I believe AI is going to have truly smart contract global settlement. Your robot, my robot interact to kind of come to an agreement and settle. And the legal form robots that we hired as our attorneys to settle our deal, you and I, is going to have to settle in a math-based protocol money that we both can agree on. And even gold for 5,000 years, which has been an accepted store of value, whether it's in Article 10 of the Constitution or in Egypt, gold is not a math-based money. Its supply grows somewhere at 1.8 to 2% now and can expand if prices go higher. And it's not instantly settlable. I have to like ship it to you. Bitcoin solves all of that too in milliseconds, where it's hard money. It's the scarcest commodity in the world. That's where AI settlement contracts and smart contracts will be. It'll be in the Bitcoin network, in my opinion, because of that. And I think that's why companies like Lightspark are so interesting, trying to drive toward that and being those technologies that settle within that world of smart contracts.
Hold up. Over 90% of people that watch this channel don't subscribe to the channel. And we see that metric across all of Bitcoin YouTube and financial YouTube, sound money YouTube. That is crazy. Let big tech know that people want what they are getting here. They want sound money education. They want more truth. We do that by subscribing, and it also gives more resources to the content creators to provide more for you. I'm a consumer as well. I love watching this. This is why I give back. It's a calling inside, but I also learned so much over the last 15 years from YouTube that I want to give back to the community that gave so much to me. So I thank you more than you know. Please subscribe. Please subscribe to the other channels. Now back to the episode.
So what I like to think is just, no, this stuff just got created by Nakamoto and all them. And then ultimately it's led us to this time where we had crypto resistance, right? Where the Biden administration, for instance, like was so many policies against it. But now you've kind of got a mandate where, in my opinion, it was simple as the vast majority of Americans that were perhaps Democrats and labor unionists at one time that are pissed that they don't have a job ended up shifting over to the Trump, becoming a Trump supporter because he was talking plain English and talking about getting jobs back and just eliminating a lot of the nonsensical stuff that the DEI and woke agenda took a hard left turn and went out of bounds that I think even most reasonable Americans, Democrat, Republican, would agree on, that it was too much. And so people want common sense government as part of that. And because of the distrust of government, a lot of these people happen to be Bitcoiners. And I think that's ultimately what forced Washington under the Trump administration to say, we better embrace this thing, because not only these people want jobs back in America and commonsensical government, but they also want freedom, and they also want freedom over money. And Bitcoin is a real technology that's solving a lot of problems, and therefore Washington is embracing it. I don't personally subscribe to the fact that the CIA created Bitcoin, that Nakamoto. It's possible though. As I said, like, I don't think it's crazy when someone sends me those texts. I think you got to weigh it. I just don't, at 2 a.m. on the pillow, head on the pillow, I don't go there. I think it's just pretty simple, but maybe that's my simple mind, how it works. So here we are. I think it's all good that, Washington is throwing, more of the support. Am I with kind of what I would not, I love Marty Bent and those guys, but I can remember Marty talking about that. I feel like, just not to pick on him, but as one guy, and I love Marty's work, but I think Marty would probably hear him say a few years ago, like, get Washington out of this. This is awful. And I wasn't there. I was more in what Michael Saylor used to say, which is, guys, that's where the money is. The institutions are over there. You better accept the fact that the SEC needs to put some rules and regulations around this industry if we want some of that BlackRock money to come into the space and grow the asset class. That made more sense to me, that people don't want 1849 Wild West. They do want some laws over your property and avoidance of swindlers selling you land that doesn't have gold on it. You want rules and regulations that force you to have a geologist come on this land here in 1849 and drill down and do some ecological studies to try and define the probability of whether there's gold or not, right? It's that same concept of, you need some rules and regulations here. So I'm long-winded, but I kind of fall in that camp, but yet I respect kind of, again, the Marty view that no, you are entitled to your rights. The Constitution was all about libertarian views, and I 100% agree with that. So how do we bring it together and find good, commonsensical middle ground? That's where we're at as a country. Like, you're never going to get exactly what you want, but as this Rolling Stone said, you'll get what you need. And I think that how do we find that middle ground? How do we find Marty's view and Saylor's view and bring it together with something that's commonsensical and start solving real problems? And again, I could go on and on picking on both parties in Washington, like the Biden administration suppressing crypto 4 years ago, like Bitcoin Opportunity Fund. We had a hard time getting banks to take us on, to give us a custodial account or even a bank checking account, because the name of our fund was the Bitcoin Opportunity Fund.
Yeah.
And that was wrong, right? That's suppressing my freedom to do business as a business person. But is it right for Trump to go after go on the Wall Street Journal today, 5 top law firms in this country because they were doing pro bono work and driving the government agenda? And to be honest, Trump's not wrong. Like, there's some truth to what he's saying on it. But we have to be careful as Americans. Do we want the Trump administration to completely censor? Shouldn't that Wilmer Hale, as an example, law firm, have the right to go and do what they want with their time and their money and their effort? And shouldn't we, Brandon and David, as business people, decide if we want to use Wilmer Hale or not as our legal team, based on whether we agree with their politics or not, or if we agree with their like, let the capital markets let the market and market forces determine what works, because otherwise Nixon made that mistake with price controls in the early 70s. Smoot-Hawley made that mistake with tariffs in the late 20s. If you're suppressing crypto people like Bitcoin Opportunity Fund from getting a bank account like the Biden administration did, that's wrong. And is it wrong for Trump to then censor Wilmer Hale? Yeah, perhaps. Now, Trump, if he were on this call, would probably say, or whoever the powers that be, no, hold on a second, Foley, you don't have the facts right. Wilmer Hale was also doing this and funding this illegal immigrant action. That's fair. Like, again, the world is gray, it's not black and white.
Yeah, exactly. Yeah.
But ultimately, you and I come at the same place, Brandon, which is freedom, libertarianism. Let markets decide. Supply and demand and price have an amazing way of solving bubbles.
Yeah.
And that too will be true in crypto, as it was in 99 tech, starting in 2000, 2001. And then the Googles and the Amazons and the Salesforce ride off because those are real businesses, and the rest fall away. And that same thing I think will happen with crypto, and Bitcoin and gold, sound money, will sail away. And so will certain equities that are good, cash flow business with pricing power and low CapEx. So I'll pause there. I've been long-winded, but I think that's how I think about things.
Yeah, no, that's so well said. Like I said, the free market needs to reign. I think that Bitcoiners, if they can get crossed into that, censorship world, maybe at times, and maybe we go too far, right? And so it's the free market will decide. But the free market is also, like you said, we have freedom of speech, so we can say, hey, this law firm shouldn't be doing this, or I'm not using them anymore. Or we can say, hey, you shouldn't be using these tokens or these things because you better check into it more because it's not what you think it is. Like, that's the free market deciding and educating all at the same time. So I love you said that.
And just one quick thing, to be fair to Trump, like, they have the right to go investigate Wilmer Hale, as what they're proposing today, to say, we want to go look into kind of your dealings. It's a little scary, though. I think you and I are probably raising as freedom guys, because it's kind of like, I don't like things, but yet he has that right. It's as long as it's run through the Constitution. I'm just a big believer in the Constitution. As long as you're abiding by those laws, then that's fair.
Yep, exactly. All right, last couple here. So we talked about the nation state and Bitcoin entering as the Trojan horse, and now it's inside the city walls. We've got, nation states, we've got, sovereigns looking into it, countries mining. Yeah. So, I mean, where do you see this? I would love for you to unpack this just for a minute, where you see these global power dynamics of this Bitcoin, hash race, hash war, as Max Kaiser's talked about for years now. So I would love for you to just give your thoughts on this for a minute and where this is headed.
Yep. So again, continuing on, where if we agree it wasn't a CIA thing, it was privately set up by Nakamoto, but now we've come to the point where Washington is realizing we've got a global debt problem and an inflation problem. Washington's realizing that at some point in this global debt crisis that I've talked about earlier, that I think will play out, I think that what they see is that on the other side of some crisis, the only way the US dollar could maintain its reserve status, and by the way, there's scenarios where you could point out that the US doesn't want to be the reserve currency of the world, because that's why we've got some of the problems we have, right? It's been a good thing for a while. And it's a dilemma thing. So I think that, but if you want to have a strong currency to be the world leader in most things, in development and legal systems and businesses that develop here and all that innovation, you need to have a sound currency. Well, gold and silver and Bitcoin are three of the scarcest assets in the world, with Bitcoin being the scarcest. Well, we better think about making sure Fort Knox has enough gold in it, and we better think about us having enough Bitcoin to prove to the world on the other side of a crisis that you should be willing to lend us money to regrow our economy because we have sound assets in place. Our balance sheet is sound. And that's that whole thesis on, will they revalue gold to 20,000 an ounce to repair the government's balance sheet to show that it doesn't have as much debt as he thought? You have more assets. Remember, gold is valued at only 42 an ounce right now on the federal balance sheet, largely because I don't think they wanted to talk about repricing it, because they wanted to keep inflation discussion at bay after the 70s and what gold did. So I think that here we are where, those things though are important to have gold and Bitcoin to do, not only shore up your currency, but then to do what Judy Shelton has talked about, gold-backed treasury bond issuances, where you issue a treasury bond, and as long as let's say it pays 3% a year, well, you, the buyer of that, don't have to worry about inflation because you've got gold behind it. It's no different than a TIPS treasury inflation protected bond. It's just you're really backing it. A TIPS is just tied to CPI, but everyone knows CPI is worthless. I don't think TIPS will exist in a few years. It'll be gold-backed treasury bonds because now it's anchored to something that's truly inflation hedged. And same thing with the Bitcoin-backed bonds. Like, that will come. All that's going to happen. That's how they'll be able to float 10-year treasury bonds again and not be stuck in T-bill issuance land where they are now. So I think all that's coming. That's just more demand for both assets, gold and Bitcoin, throughout the world. So, yeah, I think that's where we're at chronologically, where we're inside the city walls, as you say. I don't think it's anything CIA controlling. I think it's just market dynamics and understanding the setup. And, Jason Lowery's talked a lot about this. He was up here 2.5 years ago talking. It was a really interesting conversation of, he was at MIT at the time here in Boston. And as he was the one who pointed it out, he's like, the Pentagon gets this, of the strategic Bitcoin reserve during the Biden administration. Pentagon gets it. The Biden administration kind of listens to the Pentagon. The problem is the Treasury is like, hell no. Janet Yellen and them were like, no, we cannot have anything talking about gold or Bitcoin backed. You will lose full faith and credit in the dollar. You'll cause chaos. So it was the Treasury that always overruled. Well, clearly that's changing, right? Because market dynamics are happening. And I think Jason Lowery's thesis and the Pentagon's thesis of, we're too late. As Jason said at the time, Pentagon's views were late. We should have been Bitcoin mining as a sovereign nation, 10 years ago. And we should have been embracing this and stockpiling as much as we can so that we have a sound currency on the other side, so that we can do things like treasury bonds issued that are inflation hedged tied to gold or Bitcoin, so that people will float us credit to build this country up over the next 40 years by issuing more than a T-bill. And not having a financial accident happen because our balance sheet is all short end duration. And that's where America is now. And so that's where I think I see those things going. And that's why I think the Trump administration has listened to the right people, the David Sachs, the Jason Lowery's, that have put us in this position where we're talking about these things.
It's beautiful. I mean, so I just love your insight. My last two, I would be remiss if I wasn't asking you about price/purchasing power. And how I want to frame it though is, and you just segued into this beautifully, which is the Pentagon saying they missed a boat. Well, a lot of people feel like they have missed a boat in Bitcoin. And you just alluded to earlier, obviously, that we are so early. Like you said, the panel of people up there, the quants, the big brains, and they're like snickering at you when you mentioned Bitcoin. They don't even own gold. They don't own gold, and they're snickering about Bitcoin. So it just tells you how early we are. Pentagon thinks they missed the boat, right? Like everyone thinks they always missed the boat. So, we always see, like, especially in the podcast world, you see a lot of, 0.21 Bitcoin is, generational wealth, and 0.0001 is Bitcoin. Where do you see the purchasing power of Bitcoin? Are people really too late, or are these numbers, even though they seem clickbaity on the internet, are we looking at that world, 5, 10, 20, 30 years from now where, scooping up some sats now, even though $5,000, $10,000 is a lot for the average person. Doing that now, you're going to look back, 20 years from now and say, boy, am I glad I did that.
Yeah, no, I think that it's a real simple analogy to me on that question is, it's like my 88-year-old mother still loves the stock market. And so she'll call me up and be like, well, what about this stock? And you'll say, well, it's this. And she'll say, well, what's the price on it? Well, it's $220 a share for Apple. Oh, that's too expensive. Yeah. I said, Mom, that's not the right question. It's what multiple to its future earnings stream and what free cash flow yield is it trading at is really what you should be asking, right? Because if Apple's at a 3.5% free cash flow yield, well, how's that compare to a treasury bond that yields 4%? And do I want Apple's credit risk? Do I want the U.S. government's credit risk? These are how you think about it, not the price. Well, same point in Bitcoin. Bitcoin's not 84,000. That's not the way to think about it. Forget about that price. What you want to look at is the Jesse Myers chart that we've been talking about. That again, just Google Jesse Myers kind of global asset chart, or go into MicroStrategy's investor relations and go through their slide decks on their Q4 and Q1 presentations. They always put in the back the Jesse Myers chart. It's a $900 trillion global financial assets. Real estate's about 300 trillion, debt's 300 trillion, and the other 300 trillion is a combination of cash at around 100 trillion, equities at 100 trillion, and then a bunch of other things like gold is like 16 trillion on it. I think Bitcoin's at 2 trillion, but it's really like 1.8 trillion today. And I think gold's overstated there. Personally, I think it's lower, but because that's counting like antiquities in the Vatican and around people's necks. And to me, people aren't selling that. I think the gold market's smaller than Jesse states. Art's like, 8, 12 trillion, something like that. The point is this: 1.8 trillion Bitcoin on 900 trillion. So if we call sound money assets gold and Bitcoin, let's just round number $12 trillion. Let's put that out right now, right? And let's put some inflation on global assets to a quadrillion. Let's call it, $1,000 trillion. Well, guess what? Like you're at, let's see, 100 trillion on $100 trillion. Therefore, would be 10%. And we said that gold and Bitcoin are just over 10 trillion of that. So you're less than, you call it 1% of global financial assets are in sound money assets of gold and Bitcoin. Okay. In 1980, sound money assets at that time of gold and silver were at somewhere between 8.5 to 10%, or if not maybe even 14%, but call it 8.5 to 10% conservatively of global financial assets. Okay. After that inflationary wave of the 70s. And it's actually a really good chart here. I'll share this one chart because I pulled this up last night. If you look at the 1970s, right? This is actually interesting, and this answers the question actually. So this is good segue.
Yeah.
Look at the stock market in white, the S&P 500, right? Look at 1970, 68 through 70. I mean, this was a 36% move down in the 70s. I want to show you how volatile the markets were in the 70s. 36% move down into 69 to 70. Again, tumultuous time, Vietnam War era, Great Society, inflation fears. France is sending a boat to New York Harbor to get its gold because they didn't trust the dollar anymore. And then 71, we go off the gold standard, and stock markets kind of print up 73%. The stock market went after being on 36 between 1970 and 72, 73%. Bull market, right? Wow, feels great, right? Boom. Nearly a 50% decline in stocks from 73 to 74. And then boom, back to up 72% from 74 to 76. Talk about whiplash. Well, this is because the Fed and Arthur Burns were like changing on a dime. We're going to raise rates. We're going to cut rates. And here's the Fed funds rate in blue. Like they were casual about rates here. Low on the Fed funds rate on the right axis was 5% Fed funds rate, 5.5. Stock market takes off, up 73%. Arthur Burns is a dove. Uh-oh. They're raising rates. They jack it from 5.5 to 10%. Stocks go down 50%. Okay, they've got inflation under control, we think. Arthur Burns pulls it off. He lowers rates back from a high of 13% Fed funds back to 5% in just a year and a half. Stock market rallies 72% on that. But the problem was inflation. And then Volcker comes in the late 70s and takes rates up. And if I continued into the 1980s, you see this Fed funds going up to 19 to 20% to finally sack inflation. But here's the point of the story. Look at gold. Gold is the gold line here. We go off the gold standard in 71. It went from 35 an ounce to 60 an ounce, 70 an ounce. 100% move in a year. Massive. Look at gold kept doing. Throughout the 70s, gold went from 35 to a high of, where's my far right axis, 245. So that's, I guess I have my math right. It was about an 8x move from 71 through 79. So while you tried to play the stock market, if you could survive it and you didn't puke and have whiplash, gold was the steady compounder, whether rates went up, whether they went down, because deficits were growing and inflation was growing. Sound familiar?
Wow.
So let's get the heck out of the Mag 7 that are overvalued at Apple at 30 times earnings, 8.75 times sales, mom, not 220. It's overvalued. And let's go buy the $2 trillion asset class of Bitcoin and gold. Let's combine those as sound money. That's 1% of global assets. Gold and silver were 8.5 to 10% by the end of that era. You compounded at 8x in a world of chaos. To me, this is the most interesting chart for all of us looking at the next decade in the investing world of how to think about investing. And in my opinion, as I said, Bitcoin is like buying gold back here at 35, and maybe you're at 48 right now with the equivalent. You're still so early. You have all of this ahead and you don't even know it yet. And so you need exposure to it. This ecosystem is going to grow. It will become the leading financial collateral in the world, I believe. And so I'll stop sharing there. But to me, that's the most interesting chart that I've seen, that I've kind of looked at here in the last week, that it kind of tells a story.
Man, the picture is worth 1,000 words. That's absolutely incredible. Thank you for sharing that. My last question has to do with this to a degree. I just interviewed Samson recently. He's obviously the Omega candle guy. And my question to him, which is I'm going to ask to you, because we've talked about $1 million, 1.2 million, 1.5 million, right? This is something that's come up multiple times, and how you said that they'll get it. A lot of people rush in at $1 million or $1.5 million, and then you'll be like, hey, we got to study up. You got to understand what you learn. And the people you're rushing in. My question to Samson, I'll ask to you, is, does the Omega candle, $100,000 move in a day up, does that happen before we get to $1 million, or is that something we'll see after $1 million?
Oh, I think before. And as I said, where I agree, I have no idea on timing. Like when I hear people say it's going to $1 million a coin in the next 2 years, like, I don't know. I deal in probabilities. Like, I don't know what the probability of that is. Like, it's not zero. They're not crazy, but is it less than 5%? Probably. But as I said earlier, there will be moments in economic history here that play out where this thing will go to a 7 standard deviation move, which will put it into some Omega candle like you're talking about, and put it at prices that are closer to where Samson is than I am. What I'm comfortably saying is, when I look back at the 70s and that gold move, I feel highly confident that over the next 10 years, we're going to have whiplash like that in markets. Rates are going to do that. I think ultimately they're going to have to do. The difference with the 70s is they could do that with rates because we were only 35% debt to GDP. We're at 120% debt to GDP now. They can't do what Arthur Burns and Volcker try to do, raising rates. You will absolutely break the system. No one in the world can do that. That's why I think Samson could be right, where this stuff makes the 7 standard deviation move faster than we can imagine, because they're forced to do yield curve control and pin it. When that happens, that's back to Larry's point. We're tying everything together now. Larry's point of the big print happened. They have no choice. And even those people that laugh at all of us in Bitcoin, they're going to be knocking on your door saying, actually, I get it. Am I too late? Should I be buying it? And the answer is, yeah, you need to inflation hedge, because the math then in what your dashboard should be is the Jesse Myers chart. You're only at 1% of global financial assets in sound money today. It's going to be probably at least 8.5 to possibly 20% at that time. And there'll be inflation. So let's just keep math simple, go to a trillion, 1,000 trillion at that time, not 900 trillion of assets today. If we go to 20%, That's $200 trillion in sound money assets if you had some massive financial crisis. We're only at 12 today. Well, there's a 10x move coming to gold and Bitcoin, and I think Bitcoin will be the fastest horse in the race because of the reasons we talked about, how much more scarce it is, how easy it is to have your wealth stored in your phone, and how you can take it with you wherever you go in the world with your 12 seed words, your self-sovereign, all those things, the security of the network, the cap on supply, all those things. That's where we're at. And so I'm highly confident Samson's going to be right. I just don't know the timing. I'm conservative. Again, learning lessons from my own history of thinking oil would clean up by 2020, but it took to 2022. So that's why I say in my head, like, I just think over the next 10 years, how's this look? But I think, look, great fortunes will be made in this space. And I think that why do we do this? Like, why do we run the Bitcoin Opportunity Fund? Is to take pride in helping people store their value, help their families, help protect them. And that's what I get excited about, right? It's like, of course, like anyone, we're financially incented and driven and all that. And we want to win and we're competitors, but it's that fairness and truth. Like, how do you help people? And that's why you're a Bitcoin Freedomist Maxi that helps people and does podcasts like this to try and educate. And everyone's doing their duty and their part. And I think we should all be grateful for that, because ultimately that's what we're all put on this earth for, I believe, is kindness and love and truth toward others, right? Treat your neighbor the way you want to be treated type thing, And so I think the golden rule applies. And I think that we're all trying to do that. I think at times we can feel awkward because someone's like, ooh, that guy's a kook here at this cocktail party talking about Bitcoin again. But you're just trying to identify people like, just this is what this probability looks like over the next decade, financially and economically. This is how you want to hedge and protect. So being able to do that for LPs, like, that's what gives me great satisfaction is doing that. Let people sleep at night. Like, try and be that, they do no harm thing that doctors, I've always been envious of doctors that can really create such a good healing hand to someone in the world and ease someone's pain. And I think that's a gift. And I don't want to over dramatize it, but I think that if we can kind of do that to people to help give them healing on their financial protection for their family store value, that's what you're doing such a great job of, Brandon, out there. And that's, what we're trying to do as well, running a fund, trying to grow, but admittedly trying to take advantage of what we think is a great venture capital formation trade and trend that's going. But we're also just trying to help our clients protect capital.
Wow, beautifully said. Your wisdom and your understanding is second to none, David, truly. And in just that wrap up right at the end there, just makes me think of, studying Bitcoin, study conviction and patience, and the chart you just showed, all those things kind of coming together, and just patience over time and hodling with that conviction anchored in that study that you're doing.
I'll email you that chart if you want to put in the notes, if anyone wants to have a PDF of it. I think it's an interesting thing to study, just because I think that's kind of what could be ahead.
Absolutely. Well, like I said, your wisdom and understanding are second to none. Any other last words? You talked about the Bitcoin Opportunity Fund a little bit, but any other last words, anything else to share that you might be working on?
No. So that's really it. I mean, again, James and I run the Bitcoin Opportunity Fund. Our Fund 2 is open right now for investors. We just did our first close, having a good run. We've got several privates teed up. There's 2 that we're set to close in April. So if people want to learn more about the fund, bitcoinopportunity.fund, you can go to and just send us an email. We'll reach out. And we're excited that, again, this is a lot of growth ahead.
Amazing. Mr. David Foley, thank you so much for being a playable character in a sea of non-playable characters. Thank you, sir.
I love that. So yeah, thanks, Brandon.
If you're anything like me and you can't get enough of the sound money, freedom go up, number go up technology that is Bitcoin, then you can binge on this playlist right here, where we have all of our most recent interviews, like George Bodine, Top Gun graduate, How You Can Retire on 0.1 Bitcoin, Larry Lepard, Samson Mao, James Lavish, Eric Kason, Rajat Soni, Peter Dunworth, and many, many more. You're not going to want to miss this playlist here. Happy binging. We'll see you inside.